We've been looking for not necessarily a technical recession, but a significant enough slowdown into next year.
I do think the second half of the year will be much better than the first.
The underlying fundamentals are still pretty good.
The next 6 weeks, in my opinion, the news headline battle is going to be between earnings and inflation.
Overall, we're looking at an economy losing momentum faster than what we anticipated.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Matt Miller. Bramo's out, Miller's in. Futures are lower by 0.5%. And TK, we've got to start with this FX market. Euro dollar, a 102 handle.
FX is really front and center. For the joy of Matt Miller, we'll state right away, Bitcoin is not a currency, just to keep Matt in order here. But FX is a litmus paper of the system, maybe 3 times in every decade. It really, really matters. And John, I'm going to go back to David Folkers-Landau of Deutsche Bank, the day of the Putin invasion of Ukraine. He said, strong dollar will break the system. Are we there yet?
Look at some of the consequences already, Tom. The trade balance in Germany turning negative for the first time in how many decades?
1991,
really important development. Then
you
throw in the Bundesbank, just the pushback starting to build from the Bundesbank to the Governing Council, the ECB and the Executive Board. That's one to watch too.
It is. There's no question about it. There's any one of these is a different story, John. I'm going to partition it right now. And we got Ben Laidler coming up on equities. Is EMFX, and then you've got the actual FX, euro, dollar, the rest of it. But you've got the triangulation of the different pairs, and that's what we're going to focus on into the jobs report this Friday.
You want to downgrade? We've got the Morgan Stanley, Goldman Sachs, JP Morgan, Mike Ferroli on Friday, Matt Miller, downgrading his outlook for economic growth off the back of a really soggy, soft week. ISM manufacturing number.
Yeah, absolutely. And it looks like in the U.S. we're already in a recession, at least technically, right? Because we had a contraction in the first quarter, and the Atlanta Fed GDP Now survey shows a contraction of 2.1% for the second quarter. So unless the print beats that in, I think, 23 days from now, the U.S. already has 2 back-to-back quarters of recession.
Mike Wilson of Morgan Stanley publishing earlier this morning, TK, the risk of growth slowing more than expected has only increased. That's the downside. That's where the risk is tilted right now.
It is, but expect the unexpected. And it's not announced, John, but you get the tariffs of China, and I agree it's a non-event. But nevertheless, the gloom, you can walk through it over the weekend. I mean, I'm sorry. It was a huge amount of gloom this weekend. It'll be nice again to talk to Ben Laidler, maybe with a more constructive tone.
Did you notice what was on top of Miller's desk this morning, TK? It was the Ducati helmet. He came in on the bike this morning, not in the truck. The bike, not the truck. Now, Matt, can you tell us how much money you save if you come in on the bike and don't use the truck?
Well, I mean, filling up the truck costs $150, right? Filling up the bike costs more like $20. So it's definitely a big savings.
There we go. Matt Miller with us. Bramo out. Looking forward to this through the next few hours. Futures negative 0.5% on the S&P. Let's whip through this price action for you. The Nasdaq negative 0.6%. Yields just a little bit higher on a 10-year by 2 basis points to 289.86. I can tell you at the front end of the curve up 6 basis points to also 289. Tom, that's the story right now. This flat curve, this difference between 2s and 10s, it's got back to about a basis point.
Technically, we're not there, but the real yield speaks volumes. We have seen a shift in the inflation-adjusted 10-year yield. I'm sorry. That's something that I think has been underviewed this week. Again, though, John, I'm going to go to FX is being the end-all right now.
Should we catch up with an optimist?
Let's do that.
Someone more constructive. We can do that with Ben Laidler, the global market strategist at eToro. Ben, let's start here. Looking ahead to earnings season, for many people, that's the next big test. What are you looking for?
Absolutely. So that's the shoe that hasn't dropped yet, right? We've had this big drawdown in valuations. We've had the valuation recession, but earnings have been absolutely rock solid. So basically, we're in a race here, right, between inflation peaking and rolling over and us sort of going into recession. And if earnings can continue to sort of hold, then we sort of dodge that bullet and we set ourselves up for a stronger second half. If earnings crack, then that's the ingredient for potentially another leg down. Now, for what it's worth, I think expectations are already pretty low. We're looking for negative earnings growth. If you strip out the energy sector, expectations have been falling. Companies have been pretty good so far, right? At holding on to that sort of top line growth, which has obviously been helped by inflation,
right?
And managing to pass through the costs to you and I, and keeping their margins, frankly, pretty close to all-time highs.
Ben, this is the heart of the matter to me. Okay, so I get lousy real GDP growth, but I still have a pretty good inflation level, which I believe is a pretty good animal spirit and nominal GDP. Is that the script for the second half?
It's all about inflation, right? I think we're pretty close to peak inflation. If we get a little bit of relief there, that lets the Fed to sort of take half a step back. And I think this sort of recession freight train, which has sort of been picking up speed, I think takes a sort of step back, and I think gives room for both valuations to rise, which are now at 20-year averages, and some of this sort of relief of earnings expectations a little bit, at least in terms of the market. I mean, that's the sort of bullish narrative. But we do have to get through next week, which is, big inflation number and the start of Q2 earnings.
The expectations is, I think, the key. Lisa Shallot was on this program last week saying analysts are in crazy town right now. They need to bring their estimates down. And then Michael Burry tweeted last week, we've done the valuation compression. Next up is margins. What do you expect? I mean, are we looking at a 50% drop in earnings the way we did in the great financial crisis, or is this just going to be 20?
Well, 20 is your average, right? And I think this is going to be less than average. I think there's nothing inevitable about this recession, right? I mean, risks are clearly rising, but with corporates in good shape, with consumers in good shape, your technical point is well taken, but there's nothing inevitable about this recession. It's not going to be global. We saw the China PMI this morning. China's reopening, the second biggest economy in the world, and it's not going to be big, right? This is a typical Fed-driven recession. We're not going to have those sort of 2007, 2008 multipliers of, over-levered housing, over-levered banks, which gave you that sort of 45% earnings drawdown. So, and again, remember, the S&P 500 is the cream of the crop. These are the people with the big balance sheets, with the global operations. They, if anybody can handle a slowdown or a mild recession, it's them.
You are the king, Ben, of staying strong amid gloom. Compare the gloom level now to December of 2018 when you had the courage to go long in the market, one of the great calls of all time. What's the Laidler gloom meter look like right now?
Well, this has been a lot more remorseless, right? We've been here for 6 months and nothing's worked, right? We've just closed out first quarter or this first half and second quarter where literally nothing worked. Maybe Chinese equities were up 2% and the dollar was up. Nothing else worked. And so I think people are very depressed. And that's one of the ingredients for this, for a potentially better second half, that we get some relief on inflation, that valuations are already adjusted, that corporates sort of hold strong. And, maybe there's a little bit of, I don't think corporates are completely immune here, but I don't think we're set up for an earnings collapse. And sentiment, sentiment's terrible. So I think those are your 4 ingredients for a better second half.
Just on the earnings front, Ben, can you walk me through where you are less constructive? The parts of this equity market that because of earnings you would avoid?
Right. So I think right now we want to be in the market, but, I'm not a lunatic, right? The risks are high. And so I think I want to be pretty defensive. So I'm in the things that the consumer staples, the utilities, the telcos, where I think the earnings risk is a lot lower. And, the market's telling them with semis is now the worst performing sector in the market. Autos is number 2. I mean, anything that's sensitive to the economy is just being taken out of the woodshed and destroyed right now. And I think that's where the risks, remain pretty high.
The one pocket of the market that's held up, and it's energy. Yet to date, that story is absolutely ripped. There is this kind of tension between the story Matt's talking about, recession, and what's happening in the energy market, and whether those two stories can actually coexist through this year. Ben, do you think they can?
I do, actually. I mean, maybe not exactly at this price, but I think we're in a high, maybe not higher, high for longer energy environment. There's no investment. Right? Drill rates are half what they were the last time oil prices were up at these levels. The curve's still backwardated. And the biggest demander of oil in the world is recovering and is not going into recession, which is China. So I still think it's a glass half full rather than half empty story at this point.
Hey, Ben, thank you. Ben Lader there of eToro. TK, that final comment there, the fact that we've seen this stuff evolve in the energy sector for that industry, with the commodity, with China, locked down on and off over the last 2 years, that's amazing.
Yeah, the global backdrop, John, is what it is. It's 3% GDP. We may even see that marked down here a little bit, given the tail of China recovering, and of course into those important political meetings of the year. But what I would do, John, to say, and this is really the first day, John, of the kickoff of the second half after the 3-day holiday in America. John, this is where the colonies won the war. That was a celebration.
Can I clean something up?
Oh, please.
Growing up in the UK, you really don't care about this. So I'm very, very happy to wish my friends in America a happy 4th. You seem to be much more concerned about how we might feel about it, and we don't really care, Miller.
I get it. It's the same as, when Michigan loses to Ohio State for 10 years in a row, we rub it in their faces. They don't care because they're an academic school. They have all of their surveys and indexes to fall back on, and we only have football.
We can pretend I'm hurt by it if you want. It's so mean, Tom. It's so upsetting.
Well, it's
so upsetting.
It's upset. I could barely keep up this weekend, John. I mean, between the focus on what kind of hot dogs to eat and the scandal of the ketchup,
you were busy, eh?
And mustard, and full disclosure.
I'm told it's mustard
folks,
and not ketchup.
Mustard, it's not ketchup. Afterthought uses ketchup, which is Good Morning Zweigel's best hot dogs in the world. But John, the stresses out there were substantial. But I couldn't relax because it was the busiest weekend for Tottenham since time began. I could barely keep up.
Getting the transfers
with what
done,
the Tots were doing.
I understand someone stopped you to talk about Conte and his transfer policy.
What's Ronaldo going to do?
Chelsea apparently
really?
In the mix. But these reports
so?
are wild right now. Hasn't turned up to training again, so Tom will see. Do you see the tweet from the president over the weekend? My message to the companies running gas stations and selling cars in the pub is simple.
Don't get me going.
This, at a time of war and global peril, bring down the price you were charging at the pump to reflect the cost you're paying for the product, and do it now. Jeff Bezos has his own thoughts on this. We'll touch on that in just a moment.
Yeah, let's do
Futures negative 0.4% on the S&P 500. With Tom Keene, I'm Jonathan Ferro, together with Matt Miller. Bramo, where is Bramo, Tom? Where is she?
I think she's at Yorktown. She's there watching the battle monuments of October.
Is she participating?
1781, when the colonies defeated the motherland.
She'll be back next week. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In Highland Park, Illinois, a 22-year-old man is being held in connection with the killing of 6 people at a 4th of July parade. Dozens of others were wounded. The man was arrested after a brief chase. Police believe the attacker opened fire from the rooftop of a building near the parade route. China and the U.S. have discussed Trump-era tariffs that President Biden is looking to ease. Vice Premier Liu He told Treasury Secretary Janet Yellen that the lifting of tariffs and sanctions is an area of concern. There are reports that the president may announce a rollback of some tariffs on hundreds of billions of dollars worth of Chinese goods. That would help lower the cost of everyday merchandise. And the new leader of Hong Kong is signaling a cautious approach towards the coronavirus. John Lee says the city must balance travel inconvenience with limiting the spread of COVID. He also warned that people in Hong Kong should only be allowed to go about their normal activities once it's certain they're not infected. They have been identified as not being infected. Citigroup warns that oil could collapse to $65 a barrel by the end of the year, and analysts say it could slump to $45 by the middle of 2023 if a recession hits. Citi's outlook is based on an absence of any intervention by the OPEC Plus cartel and a decline in oil investments. Brent crude is trading around $113 today. And Scandinavian airline SAS has filed for bankruptcy protection to deal with its debt burden for the second time in 2 years. The carrier has been in talks with its creditors to convert $1.9 billion of outstanding debt and hybrid notes into shares. SAS also plans to raise additional equity for about $1 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We are working right now very actively to diversify our gas supplies. Clearly, this risk is there. We already see Russia cutting gas supplies to a number of countries, so something we need to take seriously.
That was Valdis Dombrovskis there, the European Commissioner for Economy and Trade from New York City this morning. Good morning. Welcome back from a long weekend stateside, and a happy 4th to those of you that haven't received that message from me already, from Tom Keene.
Very good.
Matt Miller. I'm Jonathan Ferro. Futures are negative 0.4%. The main event this morning is in the FX market. Euro dollar briefly, a 102 handle. You have got to go back to 2002 to see the currency this week, Tom. It has been a long, long while.
EM gives way as well. I looked at Thai baht first thing I did when I came in. I know it's tangential, but nevertheless there it is. Turkey's idiosyncratic. We're not going to look at it. But, John, there's partitions in FX analysis that we've got to look at. And I'm not going to mince words. David Folkers-Landau of Deutsche Bank, the day of the Ukraine invasion, absolutely nailed this. And he said, we're here. It's not Plaza Accord levels, but, John, it is a strong dollar.
Can we throw in the bond market as well? The front end selling off, yields higher on 2s by 7 basis points, on 10s by 3. The difference between 2s and 10s right now across the Treasury curve, 1 single basis point. Tom, just 1 single basis point.
Yeah, what I would say is there was a shift in the curve up. For those of you on radio, I'm lifting my hands where the whole curve goes up. Last week, and this week you're getting some of the squishy dynamics where you do head towards inversion and the real yield coming in as well.
Yields down last week, 4 straight days actually into Monday, now into Tuesday. Yields down off the back of weak data. Got to keep building on this. ISM manufacturing last week, the new orders component of that, dreadful in contractionary territory. Looking ahead to payrolls, Tom, which we haven't mentioned yet. Payrolls this Friday.
Payrolls will be incredibly important, and then we go into an eventful month of July with earnings as well. Right now in international relations, on Washington and on all that we see in Europe and frankly China, Joe Matthew joins us in Washington. And Maria Tadeo, after an eventful set of travels in Switzerland today. Maria, I want to talk about the diversion of the weekend was the thunderous reality that the Russians are winning the war, that both sides are grinding, and there's this story, that story, but essentially they're winning the war. Mr. Putin's winning the war, but the backstory in Moscow is he's arresting everyone in sight. Is Mr. Putin winning the war?
Look, I think militarily yesterday he was on camera, and we rarely see him these days, but he went on camera. He spoke, of course, with the head of the Russian army, congratulated them for making gains in Lugansk, and then said we're going to continue the special operation, now focus on Donetsk. If he is successful there, then that means the invasion and, of course, the occupation of the Donbass will be completed, and that is the goal for the time being for the Russian army. What Ukrainians fear, and of course there has been a very high-profile delegation here in Lugano where there's a reconstruction conference going on. They fear that once he completes the invasion of Donbass, he's going to now turn to further inroads of Ukraine. When it comes to the arrests that we're seeing play out in Russia, Russian citizens, well, Tom, this is just Vladimir Putin doing what he said he was going to do 4 months ago when he approved new legislation saying if you don't support the war, you're not Russian, you're not sufficiently patriotic, and therefore you have to be taken out of the picture. I mean, that's essentially what he said. And remember, for many Russians, every night when they watch TV, they don't hear about a war. They definitely don't hear about the arrests. What they hear is that their boys, their very brave army, is making good gains in a special operation that Vladimir Putin now says will continue.
Joe Matthew, we've lost sight of this with tragic shootings in America, our domestic politics, and the rest of it. Joe Matthew, what is the next step on Ukraine for the White House and our president?
Well, I think Maria actually got to this in her interview. It's something that we started talking about over the last week or so, the idea of using the hundreds of billions of dollars in money that's been frozen from sanctions, Russian money, to pay for not just the war effort, but the eventual rebuilding of Ukraine. I spoke with Daniel Fried last week, the former ambassador to Poland. He says this is the point that we have to be focusing on, and it's not going to come easily. But look, there's an issue here where the money is going to come from as we get a little bit closer to the midterm elections. And the prospect of war fatigue, it's something that this White House knows about. Even after, just days after, I think the words at the NATO summit were for as long as it takes. We're talking about indefinite support here and likely billions of dollars more. So either that money is going to come from Russia or there's going to have to be a much more concerted focus on keeping people trained on this, keeping Americans involved as we go into a potential recession, why we should be handing all of this money over to another country. And
let's be honest, Joe, our record on indefinite support isn't that great. If you look at what we've done in Afghanistan, you know, we said we're going to support them as long as it takes as well, and then we pulled out in a pretty messed up way.
Well, sure, and I don't know that we can compare the two, but in terms of duration, Matt, this is going to be an issue here, and it's something that the White House is already feeling. Senator Rand Paul was talking about this months ago, and the idea of keeping Republicans and Democrats on the same page ahead of November when it comes to indefinite military support for Ukraine may be easier said than done.
Are they on the same page when it comes to tariff removal? Joe, I'm fascinated to see how this is going to play out in the coming week.
This is a big story here. You're right. There is new urgency following this meeting with Janet Yellen and the vice premier of China. But no, the parties don't agree on this. Progressives want to see the tariffs stay, as a matter of fact. And Republicans are mixed on it. The fact is, though, there's an argument inside the administration. Just ask Catherine Tai, the U.S. trade representative, who doubts the impact of removing the tariffs while also losing leverage, some of the only leverage that Washington has over Beijing. The fact of the matter is, the Peterson Institute and Barclays both say that between 2 and 3/10 of a percentage point drop in U.S. prices here and U.S. inflation is what we would accomplish there. So the question becomes, Jonathan, the balance between loss of leverage and lowering prices.
Joe Matthew of Bloomberg alongside Maria Tadeo. TK, I read a couple of stories on this, including Bloomberg's version of the prospect of this happening. I thought it was interesting that maybe they pull back some tariffs on Chinese goods, but double down the effort elsewhere when it comes to technology. Yes. You've got to find some balance here, Matt. This is so important. At the same time, you're accusing the Chinese Communist Party of genocide. That's what this administration is doing. At the same time that's happening, and DC's on the same page with this stuff. You're going to go forward potentially and remove tariffs. We've talked about how awkward that is, and you can pick your own word. But, Matt, that is incredibly awkward.
Yeah, it is awkward, and it's not the only awkward situation we face, right? The president is likely to go to Saudi Arabia and meet with the pariah leader, MBS, and ask him to raise oil production. Not that they can do very much, rather than going down to Texas and assuring U.S. producers that they have his support there. In terms of the tariffs, I think this is a really interesting story because I expected it to be a lift to risk assets this morning, and it's not. We see big drops in Europe. We see big drops in futures. And the interesting point is that the tariffs are going to go both ways, right?
I promised you that response from Jeff Bezos to the administration, to the president, Tom. Inflation is far too important a problem for the White House to keep making statements like this. It's either straight ahead misdirection or a deep misunderstanding of basic market dynamics. TK, Jeff Bezos there on Twitter.
Price Theory 101. We did a course with Professor Curry of the University of Chicago. I believe he's over at Goldman right now.
We would love to catch up with Jeff whenever he's free. Futures negative 0.4% on the S&P from New York. This is Bloomberg. Talks between the US and China about pulling back on tariffs, not enough to support this equity market this morning. Good morning to you. We're negative 0.5% on the S&P. On the Nasdaq, we're down 0.6%. Losses last week, we add to them this Tuesday morning. In the bond market, Tuesday, Wednesday, Thursday, Friday last week, yields lower. Yields just a little bit higher today by 2 basis points. But picture this, last Tuesday at the close, 325 on 10s. This Tuesday, 290 on 10s. And a lot of this is about weak data, the drip feed of weak data in the United States of America, just dragging back yields on a 10-year. All through last week, most of last week, and the potential to do that again this week, going into payrolls Friday. So a big turnaround in the bond market over the last week, a big turnaround in the FX market once again this morning. Euro dollar, very briefly, with a 102 handle. Euro dollar right now, 102.95. TK, you have got to go all the way back to 2002 to see these kind of levels on euro dollar. And you can take your pick this morning. German trade balance, that's one story. I'd say look to the Bundesbank as well, pushing back against the ECB's emergency policy or the prospect of putting one together. But for Europe right now, Tom, this is very vicious. It starts to become a bit of a spiral. Currency weakness begets currency weakness. What breaks that vicious cycle?
Well, I agree with you that the spiral is part of it here. And I'd also fold in there EM, which right now we're not going to talk about. But, John, I think the EM angle bears a lot of study, a la Stanley Fischer back in 1998. Right now, and this is someone familiar to London and the continent of Europe, Gilles Moek is chief economist at AXA Investment Managers, the wonderful insurance shop in Paris. But far more, Gilles Moek is a student of the European economic experiment. For those in America, this is the interview of the day on the collapse of so many certitudes in Europe. Gilles, I want to cut to the chase when I look at trade-weighted euro. And I get it's weaker, and it really hasn't technically broke down, but we're getting there quickly. The stereotype that a weak euro benefits German exports, is that from another time and place, or is it still true that Germany will be benefited by a weak euro?
Well, actually, German exports are not that sensitive to the strength of the currency or the absence of strength of the currency. What makes the strength of German exports is more sort of, inbuilt quality of what they sell the rest of the world. So they're actually a bit less sensitive than, say, Italian or French exports to changes in the currency. But we are, in any case, in a very specific situation right now, because the reason why the trade balance in Germany is deteriorating so fast, which is obviously quite unusual, is because of what they have to pay to the rest of the world to get their energy. So we have a very, very specific situation, which has actually not much to do with wherever the currency goes.
Gilles, on flows, you and I have studied dually Folkerts, Landau, and Garber from another time and place. The gentleman over at a German bank is very concerned about strong dollar. Are we getting to a point where strong dollar is actually an international relations issue where it's removed from economics?
Well, we are still in a situation where, if you look at where interest rate differentials are right now, for instance, across the Atlantic, it makes sense that we have a strong dollar. I mean, even if the Fed is accused of being behind the curve, actually, they started hiking rates. The ECB is still talking about it, even if they will do it in July. The potential for them to go pretty deep into restrictive territory this year is quite high, whereas the ECB is talking about simply bringing its policy rates to neutral territory. So that we have a specific strength in the dollar at the moment is should not come as a surprise. Is it a political issue? Well, I think that increasingly governments are more relaxed than they used to be, at least on the European side, when it comes to the strength of the currency, especially in the kind of very special situations in which we are right now. So I would be surprised if it were to rank so high, actually, in the public debate, at least on this side of the pond, at least in Europe.
Joe, we used to talk about a German trade surplus, the current account surplus of Europe being very supportive for the currency. That story's changed. To what extent do you think this has become a bit of a vicious cycle now, where you start to see a weaker currency beget a weaker currency, and this is one that's very, very hard to break? I just want to understand your thoughts in real time as we see a euro at 102.
For me, we are still in an FX market which is driven more by growth and interest rate differential rather than any proper concerns over the current account, over the balance of payments in general. Because again, yes, I know it's spectacular because it's unusual to see that Germany has a trade deficit, but again, it is due to this very, very specific situation where they have to pay a lot for their oil and for the gas to the rest of the world. It is not suggestive of a proper deterioration in the capacity of the German economy to continue to build products which the rest of the world wants to buy. So I'd be prudent before jumping to the conclusion that the current weakness in the euro is the result of a balance of payment problem or a balance of payment reversal, if you want. Now, if you project yourself on a 5 to 10 year trend, yes, maybe Germany will have a hard time transitioning from its current growth model. The car industry in particular needs to change a lot. But at the current juncture, for me, it's really about the interest rate and the growth differential more than anything else.
What do you expect, Gilles, from the Fed going forward? I mean, it seems like they're locked into, they have to do 75 basis points here in July or else they'll lose credibility. But we had Ed Hyman on Balance of Power last week, and he was talking about personal consumption, personal spending. Both of those data points missed the estimate last week, and it's key to have the consumer obviously keep spending to hold this economy up.
Yeah, there's also only so many times you can actually fail to deliver on your forward guidance. So it's probably this kind of moments when the Fed would be rethinking its trajectory. There are lots of reasons why they should actually be more prudent, but you still want to go for what you telegraph to the market because you don't want to lose too much credibility. Now, I can tell you, very humbly, I think many economists in Europe would tell the Fed to do. Don't go to 75, because what is finally happening in the US is that we have the famous self-stabilizing forces of inflation starting to finally to emerge. We have been waiting for consumer spending to be hit by the erosion in purchasing power due to inflation. It seems to be finally happening. So a lot of the calibration, the pretty hawkish calibration of the Fed of the last 2-3 months was based on the fact that so far we had failed to see these self-stabilizing forces at play. If they are working now, well, there is a good case actually to revise the trajectory that you had in mind. It's not about breaking credibility. It's about being pragmatic about the state of the economy and what you want to achieve to deliver on your purpose, which is to tame inflation. If inflation is tamed in a way on its own, because people stop spending or spend less, normally that should make you think that you have less to do in terms of tightening. So my guess is that it's the current conversation going on at the FOMC, and it would be a healthy debate to have.
Jill, awesome to catch up. As always, Jill Mark there of AXA Investment Managers. A small technical connection problem there through that interview. Our apologies if that was disruptive for you. TK, what did Mark Twain say? History doesn't repeat itself, it often rhymes. 1970s, does it rhyme with the 70s? In the UK, the Unite Union, Royal Mail's 2,400 managers to strike between July 20th and 22nd. So that's the Postal Service, Tom, in the UK.
Scandinavian Airlines, I don't have the details in front of me, but we're getting very striky, John. And what concerns me is there's all sorts of articles that say it's not like the 70s. I get that. Labor's atomized, it's less union, particularly in America. But nevertheless, the tension's there to be disruptive. And I wonder how that folds across, John, to EM. I'm noticing in India rupiah, out to new weakness moments ago. It's a jump condition. It's out over 2 standard deviations. And I think the linkage of, we're euro focused. So there's a lot more out there going on that's important.
Well, I can fold the strikes into what's happening with the euro focus, Tom, because it's Norway too. And Matt, as you know, the dependency on Russia has been a big deal, but that's going to shift towards Norway to some degree. And what we're seeing is Norway and strikes there with the potential to cause even more pain in the energy market. And this goes back to energy and this relationship with the euro. And this is more than problematic.
Absolutely. And in Norway, seeing strikes like this is more concerning than the UK, where striking is a national pastime, right? The interesting comparison to the 70s, I think, and the pushback against it, a lot of it has to do with metrics, right? You talk to Neil Grossman, you talk to Bill Dudley, and they'll tell you, we measure inflation differently now. And if we did it the same, we might see 70s style inflation right now in the, where are we, in the 20s.
Do you think we grew up and they taught us how to strike, Matt? A national pastime in the UK.
There was a tube strike. I lived there for a few years. There was a tube strike every couple of weeks. It was just like part of the fun, right?
Do you know what used to happen when there was a tube strike? If you didn't grow up in London, but you'd lived in London for a long time, you only knew London, Tom, by the underground map. So what would happen when there was a tube strike is everyone would come up to the surface and they would have no clue how to get home. Did you see that take place, Matt? I would see that take place all the time.
I mean, I typically rode my Ducati to work after I realized that there was no way to rely on the tube. But other people, yes, had problems.
I remember
navigating.
Manus Cranny and myself, Tom, trying to navigate our way back from East London to West London without the tube and getting slightly lost.
It's a great story. I mean, I wish I had a beverage of my choice at 4 p.m. All I got this morning is the morning tang.
How was the morning tang?
I'm listening. The morning tang is good. Afterthought about some this weekend. She had a very tang 4th of July.
It tang with vitamin C in. Enhanced tang. I saw that. Is that
no,
that's a real thing?
Enhanced is when you get the potato vodka.
I received that picture over the weekend.
The astronauts drank it.
Yes.
With vitamin C, and that's
over
what people take it for now?
Yeah, the colonies. I mean, folks, we've got to remember.
I thought they stopped making this, Tom.
The weekend was about when the colonies won the war, 1781. It was a good and
that's what it was about.
Thing. Yes.
Okay. Thanks for I just thought it was an extra day off.
I'm sure you did.
Futures down 0.5% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A 22-year-old man is being held in the deadly shooting at a 4th of July parade in Highland Park, Illinois. He was arrested following a brief police chase. Authorities say gunmen opened fire from the rooftop of a building near the parade route. 6 people were killed, a dozen more were wounded. President Biden marked the 4th of July holiday by noting the U.S. has made great strides, but has also taken a few steps backwards. At a White House event, the president said Americans are worried about division within the country. He also described the economy as growing, but not without pain. Turkey has renewed its threat to keep Sweden and Finland out of NATO. The Turkish foreign minister says Turkey will not ratify membership in the alliance for the two countries if they don't fulfill their promises to extradite terror suspects. The Turkish parliament will eventually vote on Sweden and Finland's NATO applications. And the UK will force owners of apps such as social media and search engines to curb state-linked disinformation. If they don't, they face fines of as much as 10% of annual global sales. The crackdown is part of the forthcoming online safety bill. And Bloomberg's learned that a consortium led by KKR is emerging as the front-runner to buy a stake in Deutsche Telekom's wireless tower portfolio. The business could be valued at around $20 billion. In any deal, Deutsche Telekom may pick a winner this week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think the message was crystal clear from this week's remarks by central bankers. They worried about inflation getting entrenched, rightly so. So I think the notion that the Fed will blink early this time based on credit issues is not likely to happen.
Mohamed El-Arian, absolutely brilliant on Friday off the back of what's happening with credit. Spreads are wider. 580 almost on high yield spreads on Friday at the close. That's the story with credit. For equities right now, down 0.5% on the S&P, on the Nasdaq 100, down 0.6%. Right. On Euro Dollar Watch, Tom, 103 just about, trying to hold on to that level. Citi coming out with this. Vasilios Giannakis just publishing moments ago, saying 2 reasons. Risk sentiment 1, natural gas the other. And concluding, we now think the probability of euro dollar falling to parity in the near term is around 80%. Unless Nat Gas manages to stage a strong reversal to the downside, it is very difficult to see pressure abating for now.
Amy, give me the chart if you can, the EU chart of Nat Gas. Let's look at this very quickly here, John. This is very different than what we see in America. It's real simple. Out of the Netherlands, a big surge up. And, John, critically above the moving average I used for the February spike.
Unreal, Tom. And that's where the pain is. And here's the problem, Tom. Do you think we've seen the peak of the pain?
No.
When it comes to gas?
No.
And that's the problem the US
calendar,
got.
The calendar, you run an algebraic equation, folks, and you got to put the calendar into it. Someone who's very, very good at this is Amrita Sen. She was absolutely brilliant the last time she was on with us, and we lean forward now with a gentlelady from Energy Aspects. Open question, Amrita, with all that's going on. What is a significant paragraph in the note you're going to write this week? What's the thing that you're really studying right now?
2 things I'd say, Tom. First and foremost is around recession. I do think while there's a lot of fears around exactly how the recession is going to pan out, what it means for oil demand, for us, the critical thing to highlight is that Asia, and I know you and I have talked about this a lot of times, China's reopening. I really do think recession, or at least a mild one, is actually priced in. If you look at December 23 Brent futures, we're at $90. Nobody's talking about what if demand holds up a little bit better. What could prices then do? So we are looking into that. And then, of course, on the supply side, we've got the strikes going on in Norway, the Libyan outages. But, we've got some seasonal pressure coming through as well.
Are the responsivenesses, or the fancy word elasticities, of natural gas the same as oil? Is the elasticity of Netherlands nat gas like Brent crude?
So I would say on the industrial side, well, let's start with the consumer side. On the consumer side, absolutely not, right? Because from a consumer point of view, natural gas, it's electricity, which basically means that you are absolutely going to require it, particularly for home heating during the winter. Whereas arguably you could drive less unless and until you have to drive to work, right? So from a consumer standpoint, elasticity for gas it's even more inelastic than oil. Industry, however, we have already seen, if you look at Germany, Netherlands that you talk about, they are dialing down a lot of the gas consumption simply because gas prices are so high. Our models already build in some significant demand destruction in Europe because of high gas prices. And the risks to gas prices are actually to the upside, given what went on with Freeport in the US, lower LNG from there. If Chinese demand picks up in the winter, you could see even less LNG come through to Europe from the Middle East as well. So again, risks, just like you guys were talking about, is absolutely to the upside when it comes to TTF prices in Europe.
I will, Tom, I will see your elasticity and raise you a fungibility. Why isn't natural gas as fungible as oil, Amrita? We see such a huge difference in the price here versus the price in the Netherlands. Why aren't they as interchangeable?
Oh, absolutely. Great question, actually. It's just for the simple reason that oil has always been a more global commodity. Remember when the US used to not be able to export crude, we had WTI trade at $20 discounts to Brent, right? That's when it wasn't as fungible. Now with exports allowed, again, ultimately the price will dictate flows, whereas gas is slowly getting there. It's been more regional markets. And even right now, the US doesn't export as much gas as probably it could do at these current prices. And then, of course, you've had the outages at Freeport. So that's the big problem and the difference in gas. It's always been more localized markets, Middle East supplying Asia, Russia supplying Europe, and kind of US, its own little market, US and Canada.
I want to ask also about the competing calls on oil this morning, Amrita. Citi, of course, $65, which makes sense if we have a deep global recession. On the other hand, JP Morgan is saying it could go as high as $380, which is, an eye-grabbing headline. But what Natasha Kaneva puts behind that, I think, is even more interesting. She says, this is the JP Morgan analyst, that given Moscow's robust fiscal position, they can afford to weaponize oil and just pull 5 million barrels a day off of the global market. Do you think that's realistic?
We actually don't think that's likely because so far we still see Russia acting as a rational player in the market, both for oil and for gas. It doesn't mean that energy doesn't get weaponized, particularly in the winter, more so for gas than oil. We could see that, but definitely not our base case. But I think in both cases, what I will highlight is that these are very eye-grabbing numbers, precisely because, you guys are talking about it. It makes the media headlines. I would argue even in a pretty deep recession, I just don't see oil prices going below $80, maybe even not even $90 because of years of underinvestment. Look at the US at $120, $110 WTI. The Dallas Fed survey, all it talked about was labor shortages, equipment shortages, and steel costs. Nobody's actually able to raise production very much. So that's on the one side. If Russia were to actually cut 5 million barrels, but it doesn't even have to do 5, it could do just 2 or 3, given how tight the market is, you can literally pick a number. 380, it could be 4 something, it could be 2 something.
Rita, just to jump in, because we only have like 20
that
seconds,
we've never been before.
So forgive me. Could the global economy tolerate anything with a 3 handle once you get to 200,
No, absolutely
300?
not. We would. No, absolutely not. Then the only reaction has to be a very, very deep recession, and oil demand has to collapse by 5 to 8 million barrels per day to even balance this market.
Amrita Sen, thank you, just for clarifying that. Of energy aspects, Amrita Sen there, just on what's happening with the commodity market. That's your floor, maybe 80 for the likes of Amrita, Matt, and once you go above 200, most of these guys in this market, these analysts, just do not expect this economy to tolerate that for very long at all.
No, the economy couldn't tolerate it for very long, but the market may be able to do it. Remember when we went negative?
I agree with you.
Yeah.
There's a price.
Yeah, the price action is, I mean, if you see real tinkering with the supply, then the price action, the sky's the limit, basically.
Looking ahead to payrolls this Friday, this from Citi just moments ago, Tom. They expected to slow down to 290. They're on your page. A clear slowdown, sure, but well above long-term trend growth and clearly above recessionary levels.
I mean, that's the game we're going to have into Friday. And we don't have an ADP report this week, right? Am I right?
We have to wait for that, Tom, for a while, I'm told.
No, it's frankly better. I'm not.
You're not disappointed.
No,
you're not alone.
It confuses.
From New York, this is Bloomberg.
We've been looking for not necessarily a technical recession, but a significant enough slowdown into next year.
I do think the second half of the year will be much better than the first.
The underlying fundamentals are still pretty good.
The next 6 weeks, in my opinion, the news headline battle is going to be between earnings and inflation.
Overall, we're looking at an economy losing momentum faster than what we anticipated.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Matt Miller. Bramo is out of the building. She'll be back next week. Your market, not much change here. We're down another 0.4% on the S&P. And Tom, the downgrades are piling up.
The downgrades are piling up. John, we're all going to die. Out moments ago, the research piece of the long weekend, always the bull, John Stolfus of OPCO. And I'm sorry, John Ferro, it's real clear. Mr. Stolfus says consider the second half of the gloom of 1970. We went from minus 24% to plus 33%. He says the gloom is way overdone. Look at history for lessons.
Okay, but would you acknowledge that his optimism has been way overdone as well?
I would say that we're in a bear market, and anybody bullish, whether it's John Golub or
he's at 53,
John
30
Stolfus
year
or
end
others.
on the S&P.
Well, okay, he hasn't adjusted yet. Maybe he'll adjust down. I'm just saying the gloom this weekend, John, it was stunning.
Catch down seems to be the story right now because it's been Goldman, Tom,
yeah,
Morgan Stanley,
yes, that's the
Mike
right
Ferretti
phrase.
over at JP Morgan. They're all revising their growth outlook lower.
Well, they're revising it, and Matt Miller had a very important point. First one this year, and John, Matt Miller said, "Is it about the economics of the moment, or is it about the financial markets of the moment? And are they on the same page?" Is an important question into Friday's jobs report.
Matt Miller, which one is it?
I think. Right now, it's really about the economics. I've been watching closely ever since reading the notes last night, the Atlanta Fed GDP Now survey, and it shows that we're in a recession technically. Now, I was talking to Gary Schilling about this weekend, and he said, we're not in a recession until the NEBR says we're in a recession. But clearly, if we have two quarters of contraction back to back, this economy isn't as strong as a lot of the optimists think.
That's when you get to call it a technical recession. To Gary's point, you need to see a breakdown in the labour market, something more broader, Tom. And we're not seeing that. And this is what Citi say. And I understand that the labour market's the backward-looking tool. I get all of that. But this is the point that Citi are trying to make this morning. And I think they're on your page, Tom. 290 is their estimate for Friday in payrolls. That is a clear deceleration. That is a clear slowdown in jobs growth. They go on to say, though, but also well above trend, well above long-term trend growth and clearly above recessionary levels. Is this just a battle of semantics, TK? Does it matter? You're cool.
I don't think it's about. I don't agree that it's semantics. I think there's some very important analysis going on here. And just as one idea not discussed right now is the partition of the domestic economy dynamic, and there's some real gloom there, versus the complete uncertainty of the international dynamic as well. My answer is, you look at the mood, and the mood now is as gloomy as you can be. Do you have the courage to step in amid this gloom? And that's the point of debate that we're in this week.
That's the Marko Kolanovic view over at JP Morgan. His view, Matt, is that things are so depressing right now. The average investor is so negative that it's a low bar going into earnings season. Jonathan Golub of Credit Suisse is on the same page, and they think, Jonathan Golub, for instance, at Credit Suisse thinks we can get double-digit gains in the back half. Marko Kolanovic over at JP Morgan thinks that we can recover the first half, losses in the second half in some parts of this market. There are some optimists out there, and I think that plays against some of their own views, which is that everyone's bearish, because on the south side, Matt, I can find some constructive people.
I do not think it's a low bar going into earnings season. If you look at the analyst estimates, and we were talking about this with some individual stocks, and we were talking about this with, strategists like Stoltzfus, they still haven't revised down their forecast. They still haven't revised down their expectations, and that needs to come. You have a problem when you don't listen to Cassandra, right? Cassandra was gifted with a vision of the future, but cursed by the fact that no one would listen to her. And Michael Burry on Twitter, his handle is Cassandra, points out valuations came down in the first half. Margins are coming down in the second.
Is Cassandra with BNP Paribas? Have we booked her?
We've booked her. She's joining us a little bit later this morning.
I just was hoping so.
You won't listen to her, though.
Abramowicz would never be quoting Greek mythology. I mean, I'm sorry.
Tom, Mike Wilson over at Morgan Stanley was super diplomatic on this point on companies and earnings. Our experience is that the higher quality companies will admit the problems earlier. And that's what they're looking for from the high-quality companies this earnings season. Futures right now, negative 0.4% on the S&P. On the NASDAQ 100, down 0.5%. And here it is. We have got to talk about this. If you're just tuning in worldwide on TV and radio, we've got a 102 handle on euro-dollar. 102.97, Tom. We're down 1.2%.
Yeah, to steal 20 seconds here, John, how do I look at this? I go to the Bloomberg, and I triangulate to see what's moving, and without question, it's an ugly euro morning. And then I go over, John, and I look at the great trade-weighted currency statistics of IMF and some of the major banks, Westpac, Deutsche Bank, Morgan Stanley, and others. And the answer is trade-weighted may not be as grim as some of these pairs, but boy, are they moving in a challenging direction.
I'm a simple man. I just get the chart up and wait to see how long I have to take it back. Okay. Since the last time we saw it here, and it was 2002.
You got to do more than that. You got to extrapolate out, which I did, Plaza Core, DXY, and the answer is, that's what you got. I know we got to get to David.
This was a lovely chat, Tom, and then someone just jumped in my ear and shouted "guest" really abruptly, and ruined the mood of the morning.
It's Cassandra's in the control room.
David Riley joins us now, Chief Investment Strategist at Blue Bay Asset Management. David, I want to go straight to high yield. The additional compensation that some of these riskier companies have to offer this market over the risk-free asset, and that's getting wider, bigger. Pushing 600 basis points in and around 580 right now. David, when does that become a problem for this Fed? Mike Schumacher of Wells last week said it was a feature, not a bug. When does it become a bug and not a feature?
I think when we get to something like sort of 800 on US high yield, at the moment, we're not really seeing that much kind of, dysfunction or distress within the high yield market. Primary supply has been crushed, but most of the companies kind of termed out. They have pretty low refinancing requirements, and the distress ratio, so bonds trading wide of 1,000 basis points is about 10% of the market. It's as you said. I mean, the Fed wanted tighter financial conditions. That meant wider credit spreads, higher rates, lower equities. That's what it's getting. And I don't think at the moment that's enough to kind of make the Fed blink.
David, you are known for great acuity on asset allocation and decision making. What is cash right now? Is it something to avoid? Is cash something where you sit in it as an emptiness, or is it actually an interest-bearing object?
Look, cash is an asset, and I think it's an asset which offers, fair amount of option value for investors at this point in time. So, we are running above sort of typical cash balances across a lot of our strategies. Obviously, inflation is eroding the real value of that. So we want to be deploying that on behalf of our investors. And at the moment, the places where I think there's some value would be in, to be honest, to go up in quality. And I know others have said this, up in quality and improve the liquidity of your portfolios. And I think investment grade credit is actually starting to look pretty interesting. Break evens are pretty wide. We've seen a meaningful repricing across investment grade. And if we do go into recession, you've got a little bit of cushion coming from any rally you might get in duration.
Are we in a recession now, David?
It feels like we're in a recession. I think Europe is going into recession. I think the UK is in recession, and I think it's an open debate in terms of the US. And obviously, the payrolls report on Friday will be interesting, as will be the FOMC minutes later this week.
David, we used to have this old cliche in the market: you can stop panicking when policymakers start to panic. Does that hold true anymore, David? What does that mean this time around in this market regime?
Yeah, I think what has fundamentally changed in the market regime, and I think we're all kind of struggling as market participants and investors to adjust to it, is that in the sort of pre-pandemic lowflation era, any kind of growth scare or growth issues, we knew the central banks would come in and provide support. But they're not in that position to do so now, because inflation is just far too high, and they're worried about their credibility. They're worried about second round effects. So, I think the danger is, if you like, is that policymakers, leave it too late to panic, and we actually, by being backward looking, end up, raising rates too far, and ultimately push the economy into recession. And I think if the Fed goes meaningfully above 4% in the Fed funds rate, we're going to get a recession. And people debate whether it's going to be a deep recession or not. I mean, who knows? But I wouldn't like to be, too aggressively positioned going into that kind of environment.
David Riley of Blue Bay Asset Management. The new consensus, a shallow recession. That's how quickly this consensus has moved. We've gone from hardly any hikes this year to no recession to recession, but a shallow recession.
Long and shallow.
Long and shallow. I thought it was short and shallow. Is that the consensus? Whatever.
There's
a lot going on
right
this
answer.
morning, including US and China talks about removing tariffs. And we understand, according to the Washington Post, that Secretary Blinken could be meeting a Chinese counterpart at the G20 this week. That's one story. Here's another. Matt Miller, what do you make of this? The German cabinet approving a bill to enable energy company bailouts. If that doesn't speak to the energy mess in Europe right now, what else does?
Yeah, absolutely. And you heard Robert Habeck, the Green leader, saying that energy could be Germany's Lehman Brothers moment, right? They're going to do maybe a $9 billion bailout of Uniper, the natural gas company, or the subsidiary of the Scandinavian natural gas company, and they're going to pass more of the costs along to consumers. That's going to be a real problem, because German inflation looks like it's turned over a little. If you look at the chart, it's come down a little, but it's going to go right back up with that.
I did the walk of the newsroom in the morning and dropped by Tom's desk to see what's on the Bloomberg. And Tom, what's there pretty much every morning for you? European nat gas.
Well, we're looking at European nat gas as the big distinction here, but the biggest thing, folks, is to see John come through the newsroom in the morning and walk through my entourage. He's got to get past like 8 people.
Are you admitting
stunning.
you have a bigger entourage than me now?
Well,
have
that's
just
part
done
of
that?
my agreement. Yes.
Confirmed.
I have to always
Good.
have 2 more people than you.
Futures down 4/10 of 1%.
4 less than Abramowicz.
Is that in your contract?
Yeah,
I bet it is.
I have to have 4 less than Abramowicz.
The Nasdaq down 0.6 of 1%. Bramo is out. We miss her, but Matt Miller's filling in. We love that. Until next
Is
week.
she on the Amalfi Coast too?
She's not,
Right?
Tom.
Is there
Crete,
something
I'm
missing?
told. Crete.
Oh, Crete.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In Highland Park, Illinois, a 22-year-old man is being held in connection with the killing of 6 people at a 4th of July parade. Dozens of others were wounded. The man was arrested after a brief chase. Police believe the attacker opened fire from the rooftop of a building near the parade route. China and the U.S. have discussed Trump-era tariffs that President Biden is looking to ease. Vice Premier Liu He told Treasury Secretary Janet Yellen that the lifting of tariffs and sanctions is an area of concern. There are reports that the president may announce a rollback of some tariffs on hundreds of billions of dollars worth of Chinese goods. That will help lower the costs of everyday merchandise. And the euro sank to a 20-year low against the US dollar today. Investors are betting on the prospect of a less aggressive hiking cycle by the European Central Bank. The euro fell below $1.03. It is down more than 9% against the dollar this year. And British Airways is scrapping more flights from its summer schedule. Like a lot of carriers, BA wants to end last-minute cancellations caused in part by staff shortages. British Airways has now reduced its timetable by 11% through October. The UK government has waived rules that require airlines to use takeoff and landing slots or lose them the next season. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
overall, we're looking at an economy losing momentum faster than what we anticipated. So right now we have a recession call for beginning the first half of next year, but I think if anything, the data shows that timing looks like it could be even sooner.
That's the sound of an economist who's about to downgrade their outlook for economic growth.
Yes, it is.
I mean, that's my interpretation. Yours too, Tom. That was Sarah House of Wells Fargo, senior economist from New York City this morning. Good morning with Tom Keene. I'm Jonathan Ferro, together with Matt Miller. Bramo is back next week. Futures negative 0.6% on the S&P. On the Nasdaq 100 down 0.75%. Euro dollar, do we have to get used to this? Sub 103, 102.90, negative 1.26%. And Jordan Rochester of Nomura, Tom, confirmed to join us in about 20 minutes' time.
Yeah, thrilled his saxophonist will be with us. It's going to be great to talk to him. John, is there a bid here? And the answer is no. I haven't seen a bottom.
No, and there are two reasons for it. Sentiment, investor sentiment, one, this according to Citi, and nat gas, two. And Tom, unless you can see a turnaround in the latter, there's problems ahead for Europe.
We were up on the script. We could do this with Joseph Matthew, of course, holding court on radio with an incredibly important conversation. Sound on, and he joins us here in a far too early morning for him. Joe Matthew, if this was President Trump, he would be out on Fox morning talk shows screaming about a stronger dollar. Not the politics of it, but the fact is the former president was upset about the ramifications of a stronger dollar. What's the dollar policy of President Biden?
Well, I think it comes through the end of the policy on inflation. That's the conversation that we're having first. And when I say that, I mean consumer prices specifically here, which is why we're back talking about something else that Donald Trump spent a lot of time on Twitter about, and that is tariffs and trade with China. This is apparently going to be unfolding in the next couple of days. You know, we have to get to this story, look at where it began. The tariffs against China were implemented in a series of rounds. The first couple of rounds were about industrial equipment. They were about transportation. Then things like consumer goods were added after the fact. So if you find, the president lifting tariffs on things like bicycles and sunscreen, some reports suggest that he could actually increase tariffs on some of the other. How that impacts inflation and the dollar in the end is unclear, although from what we've heard from some very smart people, Peterson Institute, Barclays, they suggest that it would be muted, 2 to 0.3% decline in the rate of inflation.
And Joe, there are really two international issues that we're focused on this month in terms of the Biden administration. One is the tariff talks that you've explained so well this morning. The other is the trip to the Middle East and Mohammed bin Salman to ask for more oil production. What's the likelihood that we really get something out of that?
Well, did you hear the president when he was in Europe asked about this? And he said, no, I am not specifically asking Saudi Arabia to increase production, but all of the parties who will be there, which sounds a little bit like tamping down expectations ahead of what's going to be an incredibly important trip, asking the Saudis and others to open the spigot here. But, when you back off and look at this, you'll find just as many skeptics about that idea as you do about the tariff idea. All of these are kind of biting around the edges to try to fight this inflation problem, just like the release from the SPR, like so many other things that this White House has done to try to build a wall here. And we can keep putting bricks in this wall, but not everyone sees the actual result being what they want.
I mean, Joe, as you know, Nikki Haley, and I don't want to get into it right now, did some inflation mathematics this weekend, which went viral on Twitter. They did, folks, I'm not going to go into it, but they completely screwed up the mathematics. The mathematics, Joe, of your view of the administration, these are all teensy-weensy little things. What can he do substantial to get away from teensy-weensy additive changes?
If I had the answer to that, I'd probably be working for him right now. Because...
Well, maybe you will be, because when's the shift come up? It's a sweaty, hot July. Matt Miller says everything's fungible. Is the staff of the White House fungible right now?
Maybe the staff of the White House will be fungible after November. But no, look, I don't think this is a White House that has that silver bullet that you're asking for as much as Joe Biden wants it. It is about nibbling around the edges. The hope, though, is that you can create a composite effect with these smaller moves to actually have a meaningful impact on inflation. The fact of the matter is Bloomberg has some very smart people when it comes to economics. You are some of them. And you know that if we start talking about an economic pullback or an actual recession here, that may be the only thing close to a silver bullet.
Hey, Joe, great to catch up. As always, down in D.C., Joe Matthew there. Do not miss Sound On a little bit later on Bloomberg Radio. Weekdays, of course, at 5 p.m. Eastern. We need to talk about this FX market. That is a break of 120 on cable, sterling 119.93. Euro dollar earlier this morning with a break of 103 at 102.90-ish. There you go, Tom. Euro dollar, a breakdown. Sterling, a breakdown.
Yeah, and I don't know which one's a bigger deal here. I would suggest that most of the people we talk to, John, are watching sterling as separate, discrete, and something that could really cause some social angst within the United Kingdom. I think it's an important point, John. If you have weak yen, do the Japanese people care? If you have weak sterling, do the British people care? If you have weak euro, do the people really care? And I think that's a point of study this week.
If you're importing inflation right now, you care.
The Germans care a lot about weak euro.
In what way do they do that, Matt? Color that, please.
I would just say that the Germans follow exchange rates much more closely than the Brits or the Americans, as far as I can tell, and especially, Tom, with the trade deficit story that you've pointed out, they're going to be looking much more closely.
I didn't point that out. Ferro pointed that out. I was asleep.
Look, front and center is an energy problem. So if you're an energy importer and you've got a weaker currency, you've got a big problem, haven't you? Let's make this really, really simple. And that's why a lot of this becomes a bit of a vicious cycle.
Okay.
And you wonder how it breaks, Tom.
And you guys have lived the calendar. To the both of you, when does the change in temperature and seasons click in on the continental energy story?
Well, that's one for Miller, since he lived in Germany and I left Europe a long time ago, Matt.
Well, I will say that deep into September, you can have temperatures higher than 30 and even up to 40 in Berlin. That's Celsius. I'm not sure what the Fahrenheit
Thank you, Matt.
exchange rate is.
Please, you've gone so Euro, you're only thinking in LaQuai and Celsius.
It's not till the end of September that you really get a cooling.
There we go.
In
That's
Germany.
all I wanted
Well, that's
to
for
know.
Germany. I do remember it in England, Tom, that the weather, you never know. It could be July or August when the cold starts to kick in.
You know, I'm learning here. I talked to one of Abramowicz's entourage. John, she's like top ticking you. I mean, I can't keep up. My goal is to go below 52nd Street this summer. And maybe get down to Ruby's at Coney Island. She's in Crete somewhere.
Yeah. That's the annual trip to Crete. We
Where's
know that.
Crete? It's in the Mediterranean, right?
That's right, Tom, over by Greece. It's a Greek island.
And she's like some holistic Epicurean, everything's fresh kind of restaurant.
Is that right? Are you naming the restaurant that she's at right now?
No, I don't want to do that.
Is that the zip code?
I would never want.
If you put the zip code on TV for where Bramo is,
if
right
you
now,
want to send a postcard.
you don't respect anyone's privacy, Tom.
John, it's big. It's the zip code for the entire island.
That's the entire island. How big's the island? I'm sure they can find her. Coming off the back of a week of losses, and we add to them this Tuesday morning. Good morning to you all. We're negative about 20 points on the S&P and down 0.5%. On the Nasdaq 100, down 82. We're negative 0.7%. We've talked about the downgrades building for the economic outlook from JP Morgan to Morgan Stanley. Take your pick to Goldman Sachs. All of them for the outlook. Chop, chop, chop. Citi remains somewhat constructive. Citi believe this Fed will keep on hiking. This Friday, they look for 290 on payrolls. The consensus 273, down from 390. A slowdown, yes, but for Citi, they point out that is not a recession. Not recessionary levels for them in this labour market. And some of you might scream back, yet. Let's talk about the bond market. The bond market has been responding to weaker growth, that's for sure. On Friday, an ISM manufacturing with a new orders component in contraction territory. We haven't seen that since May 2020. In your bond market, it was yields lower, yields lower, yields lower, yields lower for 4 straight days. We opened back up this morning with yields just a little bit higher, Tom, up by 3 basis points on the day.
As I mentioned earlier, John, the distinction to me here is we had shifts in the curve last week, and this week we've got dynamics in the curves. That's the big change.
Reversing some of the moves we saw last week. And, Tom, you might have a look at the difference between 2s and 10s. That difference just a couple of basis points right now. That curve is getting flatter again this morning.
And there's a big distinction between flat and inversion, John. That's not a small item to pros.
Right now, Tom, that distinction is just 2 or 3 basis points. Yeah. That's the bond market. Here's foreign exchange. Euro dollar, a break of 103. 102. A break of 103, and you've got to go back 2 decades for the last time we saw this in 2002. 102.87. And I go back to the worker city, Tom. 2 points they're making this morning. Risk sentiment is one. The second one is nat gas. And if you don't believe that nat gas starts to turn the other way in Europe, then get used to the look of this chart right here and those numbers.
That's the politics, but let's frame a 1.03. Euro came at a 1.16 a million years ago, and there was that whole weak euro bit, John, down to what, 0.85, 0.89? So we're in between the span, if you will, of euro.
115 is the high of the year so far, I believe, very close to those levels. So that is a big move lower. Jordan Rochester of Nomura is going to catch up with us a little bit later this morning. 15 minutes away. Do not miss that conversation. For a while now, he's been waiting for this one to head towards parity. That's your cross-asset price action. Let's get you some single names. I'm pleased to say we can do that this morning with Kriti Gupta. Morning, Kriti.
Well, good morning, John. Let's talk about that FX story, because as we see that euro-dollar drop and weaken and weaken and weaken, that dollar strength is what's really crucial here. You mentioned natural gas prices. We'll take a look at this. It's showing up right here in the U.S. stock market with those oil names, that class of inflation hedge that's been working fairly well this year to date. It's working this morning as well. Occidental, Exxon, Devon Energy, all higher on the day. And those names that have more exposure to American production, like Occidental, actually outperforming the likes of ExxonMobil, which is a little bit more diversified. But once again, it's that oil story in the face of stronger dollar that continues to be key. Let's stick with the stronger dollar story, though, because as you see, it has ripple effects across not just the oil and the commodity names, but other names, other multinational companies that has that exposure to abroad. And names like Nike, Starbucks, Microsoft. The common thread here is that all of their businesses have this massive exposure to China, to Europe, bringing back those profits into the state, turning them into dollars. That's going to have an effect on the bottom line. And staring in the face of the greenback, you can see already right off the bat this morning, they're already weaker this morning, Tom.
Kriti, thank you so much. Greatly appreciated. Right now, we reframe into the second half of 2022 with Mark Cabana, head of U.S. rate strategy at B of A. He takes in Ethan Harris and the team on economics and folds it right over into the fixed income space. Mark, I'm going to go short right now. LIBOR is lifting. I'm sorry, I'm old school enough where I still care about 3-month LIBOR. Up we go, the moonshot. What is the significance of the short-term trust market showing higher yields?
Well, it could mean 2 things. 1, it could mean tighter Fed policy, or 2, it could mean a broader tightening of financial conditions and worsening of credit. We think it's more the latter right now. We think it's just the Fed policy that's kicking in, causing overall front-end rates to increase. And that's going to have a tightening of financial conditions, especially if you're a floating rate borrower. This is what the Fed is trying to achieve. They're trying to slow the economy down. They're trying to tighten financial conditions and borrowing rates, and LIBOR is a reflection of that.
What is your fixed floating analysis now? A coupon that is fixed and the dynamics of that versus a floaty coupon like John Farrell's more used to, because it is a floaty Great Britain.
Yeah, well, look, if you're an investor, you want to be in a floating rate instrument. And if you're a borrower, you want to be in fixed. It's a dynamic where the front end of the curve is rising. We do think that the curve will invert 2s, 10s. We think that you're probably going to see the funds rate inverted to the 5 and the 10-year point in the not too distant future. And again, that's to be expected with what the Fed is trying to do in order to slow the economy and ultimately try and get inflation under control.
So, Mark, let's reset. Let's think about where you think this Fed funds is heading, because some people have questioned that and actually brought their expectations in, not pushed them out. Where are you now?
Yeah, so the B of A house view is that the terminal Fed funds rate will be at 4 to 4.25% in the first half of next year. We think that the Fed will get to 3.5% by the end of this year and then keep going in the first half of next. Now, that's naturally going to be dependent upon the economic outlook. But as you were discussing earlier, look, we think that the economy will slow, but with the labor market this tight, we're somewhat skeptical that we're in for an immediate recession. We're well above the break-even rate in jobs growth that'll be required in order to see the unemployment rate sustainably increase. And our team is a bit above consensus. We're at 325 for the end of this week. And I do think that with a labor market that's strong, some of these discussions of an imminent recession will have to get pushed out, because you really need to see the labor market slow, we think, before a recession will be nigh.
But with the terminal rate that high, Mark, wouldn't financial conditions be way too tight? Again, I spoke with Gary Schilling over the weekend, and he reacted with shock and horror when I suggested that the Fed would go to 4.25%.
Yeah, well, again, it really depends upon how resilient the underlying economy will be. We're not looking for an imminent recession. We are looking for a notable slowdown, but not an imminent recession. And we do think that the economy will be able to withstand higher overall interest rates. Now, we're not seeing that in the market today. The market has taken down the extent of Fed hikes quite meaningfully. It's priced in cuts really starting in the middle of next year and then continuing through 2024. But again, we're not there yet. And we do think that you need to see more of a labor market slowdown in order to necessarily guarantee that the Fed is going to be changing course.
How far out?
Again,
how far out do you
ahead.
think spreads are going to go, Mark? What should we be looking for there?
Yeah, well, we think that the financial conditions broadly have to continue tightening. That is what the Fed wants to see. They're already seeing some response from tighter financial conditions in terms of things slowing. And I'm not a credit spread analyst or expert here, but we think we're probably only about halfway through the tightening of financial conditions that needs to take place in order to get inflation lower and for the Fed to feel like they can declare victory in that backdrop. So we're still cautious on the risk backdrop.
Mark, Michael Rosenberg and the team at Bloomberg a decade ago invented the Bloomberg Financial Conditions Index. It was picked up by the IMF within 14 days as a key barometer for them. It is now sitting at a negative 1.2 standard deviations. At what point do financial conditions have to tighten to where it changes the dialogue or the belief set, the construct of our central bank? There's got to be a tip point where they change because the facts change.
Yeah, we get asked a lot where the Fed put is. And, you know, in terms of how far down from the peak in the equity market do we need to be? We don't think we're there yet. You know, we've long argued that it's probably going to be 30% down, but it could be close to 40% down. But I don't think that that's what a central bank necessarily cares about. They don't care about how far have equities fallen or how much wider have credit spreads gotten. What they care about is what happens in terms of the reaction function for businesses and consumers. When do they really start to dial back? When do businesses say, we don't need that next bit of CapEx, or we don't want to hire that person? When do consumers say, I don't need to buy that next car or take that next vacation? That's the response function that they're looking for. And we're starting to see some signs of that already. But we think that there's still a fair amount that that needs to happen in order to see that dialing back in activity. And again, it's going to look like a pretty notable slowdown or a recession. But we don't think that we're quite there yet. We'll probably get there, we think, by the fourth quarter of this year or early into next year.
Mark, isn't that the horses bolted indicator? Isn't that just really late when you start to wait for that kind of stuff, evidence of it?
Well, that's what they need to see. They need to be convinced the consumer and businesses are going to be dialing back. And look, we've seen sentiment indicators that have been very, very low for really the balance of this year. And you haven't seen that response function yet. And so, again, if you were going to be looking at forward-looking indicators or sentiment, you would have already thought that we're in a recession.
Sure.
Maybe we are, probably not, especially with the labor market that this is this strong. And so what a central bank needs to see is they need to see that dialing back of activity. And look, central banks typically overshoot, right? They either ease too much or tighten too much. That's probably what the Fed is going to be doing in this cycle, but they need to be convinced that they're seeing that adequate slowdown. And thus far, we're not convinced that they have.
Mark, that was a clinic. It's great to catch up, sir, as always. Mark Urbano there of Bank of America Global Research. Tom, take your pick for a headline. A four-handle on Fed funds. We're only halfway through the tightening of financial conditions. And ultimately, the concluding remarks there. What matters to this Fed? You probably won't find it in this market. You'll find it somewhere else.
My tone on what we heard from Mr. Cabana was go out the x-axis, and I think this is really important. Right now, the financial media, and Stolfus mentions this in his optimistic note today, there's a complete focus on the short term. John, I'll let you define what the short term is. The answer is if you go out 1 year, 2 years, 3 years, you've got to change because things get washed out. Things move on. Corporations adapt. And where are we in our analysis? Can we even go out a year right now, John? How many people are brave enough?
You're touching on the heart of the issue, and you touched on it earlier. It's the difference between the economy and the market. You've got a more constructive view on the economy and working our way through this. But when you listen to Mark there, Mark's making the point that I agree with you, Tom. I'm more constructive on the economy too, and for that reason, Fed funds needs to go higher. And for that reason, financial conditions need to tighten more.
Martin Feldstein, 101. All drops on strong dollar are stochastic. You go down, The facts change, you come back. That's the history.
Tom Keene, Matt Miller, Jonathan Ferro, Bramo out of the building. We're in Crete, apparently. The Bramo family is in Crete. Futures are negative. She'll be happy, Tom. 102.97 on euro dollar. That vacation's getting cheaper by the day. Euro dollar negative 1.2%.
Fragrant herbs,
You read the menu.
aromatic spices.
It's a menu.
It's a vibrant seasonal dish.
What's the restaurant called?
Nathan's.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A 22-year-old man is being held in the deadly shooting at a 4th of July parade in Highland Park, Illinois. He was arrested following a brief police chase. Authorities say a gunman opened fire from the rooftop of a building near the parade route. 6 people were killed, dozens more were wounded. President Biden marked the 4th of July holiday by noting the U.S. has made great strides but has also taken a few steps backwards. At a White House event, the president said Americans are worried about divisions within the country. He also described the economy as growing but not without pain. The UK will force owners of apps such as social media and search engines to curb state-linked disinformation. If they don't, they face fines of as much as 10% of annual global sales. The crackdown is part of the forthcoming online safety bill. And semiconductor stocks are trading at bargain prices, but investors are still staying away. Chips are the worst. S&P 500 group this year down some 38%. Micron Technology gave a disappointing forecast, whilst Intel said the macroeconomic environment is weakening. Research firm Gartner expects PC shipments to fall some 9.5% this year. And people in China have largely escaped the consumer inflation afflicting other major economies, but that may be about to change. The government has embarked on a campaign to rein in the market for pork. Hog futures are at their strongest in a year, whilst wholesale meat prices are at a 6-month high. Global news 24 hours a day on air and on Bloomberg Quick Tape, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The one risk I'm really worried about is liquidity risk. And we're starting to see markets locked out of funding. And keep a very close eye. Issuance in June was very low. Companies either were unwilling or unable to refinance themselves.
That was Mohammed Al-Aaron of Queen's College, Cambridge, the president and, of course, Bloomberg Opinion columnist from New York City this morning. Good morning with Tom Keene. I'm Jonathan Ferro, together with Matt Miller. Lisa out of the building on vacation. She'll be back with us next week. Futures negative 0.7 on the S&P 500. Your main event, it is in foreign exchange. Euro dollar 102.98. The lows of the session 102.81. Sterling against the US dollar, so-called cable 120. The low of the session 119.89. Some big breakdowns in some big currency pairs worldwide this morning, Tom.
Let's get to it right now with Jordan at Rochester. It's not that he's been alone, but he's been way articulate about the case for weaker euro. Jordan Rochester is with Nomura. He's been with us often. We get an update this morning. Jordan, I mentioned earlier the great Martin Feldstein of Harvard, who noticed that when you get weak euro like 1985 or 2001, you get a stochastic response. It goes down, it's weak, and it turns around. Does this have the same feeling that when we find euro weak bottom, we'll turn around and come right back?
Tom, you're kind of on the money there about the non-linearity of the euro moves. This morning, I can explain why it's moved, but it's been non-linear. It's been much faster than folks expected. And a lot of people who were looking to the normal macro drivers, the sort of ECB headlines, to suggest why it could go lower, they didn't have that. It was Norwegian gas flows. We can come back to that. But in answer to your question, I don't think euro's a buy at all, Tom. I think we go towards parity. I think we could even break parity. And the moves will be non-linear when we do that, because it will be because of gas supplies being cut off, perhaps with Nord Stream 1. And I think as we get to these levels, we've broken key levels all the way back to the French elections and so forth. Periods of very strong euro weakness. We've broken those. We're in a no man's land now, all the way down to parity.
If we are non-linear, does that suggest that Mr. Putin can drive euro lower?
He already is. And I think, yes, he can do more. So to give you some more color on why I keep mentioning gas, the move today is because German electricity prices, go onto your terminal, type in Germany electricity 1 year, the record highs for the 1 year part of the curve. So it's not a temporary story anymore. German consumers will be paying record prices, whoever's buying at these levels, for the next year. And that's going to affect consumers' contracts. So that's a consumption squeeze for European consumers. That's recession risks. Recession risks push euro lower. Norwegian workers have gone on strike. So 13% of Norwegian gas supplies are turning off this week. And we've looked into it. If someone can let me know, but we don't see an end date to those strikes until their demands are met.
That strike
so we have
escalation,
a big uncertainty on those.
Jordan, this headline just crossed on the Bloomberg that it could shut 56% of gas exports on further escalation. That's a problem. So can you tell me to what extent your call on euro-dollar, and you are looking for parity, I know that, and have been for a while, to what extent is that call basically a call on European gas prices?
It's a little bit like that. That's been the primary driver of the volatility, especially today. But there's a few other factors as well that feed into the euro view. It's not just about gas prices. Global recession risks. We're looking for a US recession in Q4 of this year. Euro does not strengthen when we have recessions, especially with the peripheral yield risks that we have in Italy and Spain and elsewhere. So there's recession risks driven by the global phenomenon of what's going on. Europe's main trading partner is China. China's going for what we call a COVID business cycle. And we've just had another wave of COVID-19 cases, some more lockdowns announced just over the past 24, 48 hours. So the exports for Germany are being weighed on by gas prices, making German manufacturing less competitive, 7 times more expensive. That's how much gas prices, electricity prices are in Germany versus America. So American exports more competitive, and Europe's main trading partner, China, is in a state of slowdown dealing with lockdowns.
Jordan, you have a lot of the same problems in your island nation there that people on the continent of Europe have. Plus, you've got Brexit seemingly flaring up again, right, with the Johnson government throwing out agreements that they made just a year ago. How much worse can it be for the pound?
Well, we are short sterling, looking for 118 in cable, and I think with the non-linear moves I just described, in euro-dollar, cable could go below that as well. So that the direction is lower. It's just a question of how much lower. And in terms of the risks of reasons, the Bank of England is less hawkish than other central banks. That's making US yields less attractive to foreign investors. The UK's trade surplus doesn't exist. It's a deficit, and it's getting wider. So the UK is facing similar problems to Europe, but a key difference is the UK has Brexit, of course, and I'll come on to that. But the UK raised taxes. National insurance taxes went up. The energy subsidies that Boris Johnson's government announced didn't really cover everybody. It did a good amount for the lower half of society, but for the middle classes and higher, didn't do much. So you're going to see a consumption squeeze. But yes, let's bring it to Brexit. I think markets are looking at the Northern Ireland Protocol noise, but I don't think sterling actually has a premium for the potential for an FTA to be suspended. Now, I don't think we will see the Northern Ireland Protocol situation lead to the EU issuing sanctions or issuing anything like that in terms of tariffs or quotas. So that's why the market is ignoring it, because I agree with the market there. But if it was to happen, who knows what can happen in these markets, then sterling would be even lower than 118. So we're looking at 110 towards parity in that scenario. That's why I don't think it's going to happen. That is just a nuclear button for the politics.
Some big calls there. Jordan, thank you, buddy. As always, Jordan Rochester there of Nomura out of the City of London. Matt Miller, here's a headline for you from the German Economy Minister, Robert Habeck, not ruling out intervening in gas prices. That just
How do you do that?
From
Wow.
Germany.
Wow.
I'd love to know, but essentially that is the statement that has just been made. Matt, your thoughts?
Well, and it's also the opposite of what we've been reading over the past couple of days, right? With the bailout of Uniper and the law change that just went through the Bundestag, we expected them to allow higher costs to be passed through to the consumer. So I'm not sure exactly how Habeck would intervene. And the interesting thing that doesn't really matter is that this goes contrary to his party's raison d'etre, right?
Oh, there you go with the French.
So, well, I'm just saying they want to reduce the use of fossil fuels, so higher prices should be good for the Greens,
Well,
right?
There's been one hell of a reality check about how you go about doing that. That's for sure over the last 12 months. TK, have you got a Netflix call in the mix as well? Going into earnings.
We're getting into earnings season here, and they're adjusting. Tom Champion over at Piper Sandler, great shop. On Netflix, he goes a little weak, and he does it, and he just says, look, that's the new streaming. Paul Sweeney is expert on this with me in radio on the 9 a.m. And the answer is streaming wars are here, John, and they ain't happening. This show, Stranger Things, which I ran into this weekend, it's going to happen, but it's not going to save Netflix, according to Piper Sandler. They go to I believe, a neutral on Piper Sandler.
What about time?
John, this weekend I'm talking to Afterthought. She's glued to this.
What's she watching?
She wants a name change. She wants me to call her 12 from now on. I said,
12.
What's 12? And it's like a character, and I don't know. They're in Hawkins, Indiana.
That's straight over my head.
I got to get up to speed.
Can I just remind you how dreadful the price action has been over the last 2 earnings reports for Netflix?
Yeah.
Down 35%.
I've never got it. Full disclosure.
Down 22%.
Where's the profit?
Brutal. Futures down 0.8% from New York City this morning. Good morning to you all. This is Bloomberg.
If anything, the Fed hikes yet more than what you already have priced in the market.
Given the fact that volatility is so high and liquidity is so low, we are a bit cautious.
I think the rest of the year, we're going to see decelerating inflation growth.
The level of demand destruction that's actually coming through is accelerating.
The consumer is on somewhat more fragile footing, so we're seeing cracks emerge in their spending patterns.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on a Tuesday, a holiday-shortened week. Well, here we are, Jobs Day on Friday. Matt Miller in for Bramo. She's off. And, John, all I got to say is foreign exchange is the litmus paper of the global system.
At TK, we've had a break of 103 on euro-dollar, a break of 120 on cable, back to 135 on dollar-yen. Front and centre, Tom, dollar strength. And fueling that dollar strength, the energy move we're seeing in Europe, shaping a view that we get a recession there, and fueling that dollar strength clearly is risk sentiment off the back of some downgrades, Tom, to global growth.
Yeah, the downgrades really get my attention, John, because there's a story here, and there's a Norway angle, and this angle, and that angle. But the real angle here is uncertainty into the second half of 2022.
Without a doubt, and we have downgraded the outlook for this economy in the United States of America, whether it's Goldman Sachs, whether it's JP Morgan, whether it's Morgan Stanley. They've all done that. Chop, chop, chop. Tom, it's earnings next, and that's going to be the big driver for many people of this equity market.
Piper Sandler out on Netflix today, and maybe that's not that germane. They've got their own soap opera as well. But what a difference of opinion, John, do we have on the earnings view forward? Ben Laidler, more optimistic than many.
Yeah, more constructive. Throw Golub into the mix over at Credit Suisse. Throw Kalanovic into the mix over at
John
JP Morgan.
Stolfus at OPCO.
Morgan Stanley and Mike Wilson have got different views on this, Tom.
Right.
They think the warnings are still in our future, and we haven't had them all yet.
Matt Miller, let's use your expertise here on Germany today, truly world class. And the answer is, in Germany, they're not worried about earnings expectations. They're worried about paying the gas bill come September.
Yeah, paying the gas bill as those prices continue to exponentially rise.
That's the right word, yeah.
I think they're also worried about selling their stuff, right? Even with a weaker euro, and we hit 102 handle today, we saw car sales come down in France, portending a bigger drop across Europe, and it's difficult because they just can't get them off the lot without the chips they need.
John Ferro, we've been ECB free today. What does this mean for Christine Lagarde? You covered Frankfurt for years. Her degrees of freedom are much more limited than Jerome Powell's.
Bundesbank pain. That's new. That's new. Not new in the last 10, 20 years, but for this president, she hasn't had to deal with a whole lot of it. She might have to now. The Bundesbank, in a speech in the last 24 hours, Tom, pushing back against the prospect of building this fragmentation tool, whatever that looks like. I think that's going to be a thorn in their side as they try and put something together. And how do they thread this needle at the ECB? I have no idea, Tom. How do you tighten financial conditions but not too much? And what is too much?
Yeah, what is
too much in Italy compared to, say, Germany? This is going to be a difficult one.
Well, I'm going to start the data check here. I'll go to FX here and say that the blended BBDXY index, the Bloomberg Dollar Index, is doing a little better than the major trading DXY through a 106 on DXY, John, is really something. And yen hasn't played 136.04.
To see 102 on a chart before today, you've got to go all the way back to 2002. 102.90 on euro dollar, negative 1.27%. Yield's just a little bit higher on a 10-year at 288. That was was not the story last week. Yields lower for 4 straight sessions, Tuesday through Friday, off the back of weak data. Just starting to see the front end lift up 4 basis points on a 2-year to 287. So your curve, the difference between 2s and 10s, a single basis point. And the inversion that some of you are looking for, Mark Cabana over at Bank of America on this program 15, 20 minutes ago, he's looking still for a 4 handle on Fed funds. He thinks, Tom, this economy is strong enough to get Fed funds through 4%, for this Fed to be able to contain inflation. That's the work that he thinks they need to do. The pushback we've had on that call, Tom, already in the last 20 minutes, massive, because people are basically coming out and saying, OK, take it to 4. Does that do anything about energy? Does that do anything about food prices? Well, I can tell you from the demand side when it comes to energy, maybe. But, Tom, as you've said a million times, you've got to eat. You've got to eat, and that is not a joke. That's the problem you've got right now, Tom. Things are expensive, but there are some things you have to carry on buying.
Well, there's no substitute for them. And, of course, Matt Miller with the word for the day, fungibility there. Wheat isn't fungible in Cairo, in Egypt. This is a joy because over a decade ago, Sam Stovall did what is hard to do. He followed on from his truly historic father and wrote the 7 Rules of Wall Street. It did rather well. Mr. Stovall is with CFRA. Sam Stovall, what is the rule of Wall Street this morning?
Well, good morning, Tom. I guess the rule of Wall Street is you don't fight the Fed. And I think that the Fed does have to remain aggressive because this is now the 6th time since World War II that we have had the year-on-year change in CPI above 6.5%. And every prior time we slipped into both a bear market and a recession. So I think there are still concerns ahead.
Sam, help me with the earnings picture as we kick things off next week with JP Morgan. What are you looking for, and to what extent is the bar low? We've got the optimists saying the bar's really low, earnings are going to be fine. We've got others who said we haven't even started cutting our estimates on that front.
Well, my father used to say that you could rarely injure yourself by falling out of a basement window. But I don't really think that the expectations are that low just yet. Yes, they've come down. On March 31st of this year, we expected to see the S&P post a 6.3% year-on-year rise in Q2. Now it's at 5%. And profit margins, which were expected to be down 4.1%, now expected to be off 5.3%, with more and more sectors joining on the negative side. So I still think that there is more downward revisions to be experienced.
Yeah, I mean, we're talking about Netflix today, Sam. Piper Sandler just reducing their call to a neutral from a buy. But, you know, John was talking about the price at $179. I see that the analyst estimates are still for $283. So they still expect a 60% gain between now and the second quarter of 2023. When will analysts bring their revisions down?
Well, in many ways, I think it's once they hear from management in the coming reporting period that not only will we end up seeing earnings come in weaker than anticipated for this quarter, but then they will be forced to reduce their estimates. In many ways, we find, prices lead fundamentals. And right now, fundamentals are holding firm. But I think like Wile E. Coyote, they're going to look down soon and realize they don't have the support that they were expecting.
Sam, can I ask you a trivial question? In your time at the Stern School of Business or learning portfolio construction for the CFP, the term drawdown to me always meant peak to trough, and you've got to fully recover before you can measure a drawdown. It seems that it's the word of the quarter this year. Everyone's using it to replace losses. Doesn't drawdown have to be measured after a full recovery?
Yes, just the way we decide whether we are in a pullback, a correction, a bear market, and whether the bear market is a garden variety or a mega meltdown. You have to wait until the trough is in, and for corrections and pullbacks, we got to get back to break even before we can say that that's what we were in. And for bear markets, we need to see that 20% advance off of the prior bear market low. So you're right. A lot of this is done in the rearview mirror. And maybe the term drawdown implies that, well, maybe you didn't sell out and actually turn a paper loss into an actual loss. So they're doing a little bit of refining on the terminology.
Sam, awesome to get your view on things going into earnings season, kicking off next week. Sam Stovall there of CFRA. Matt, you remember the Netflix numbers. A lot of that was just an industry view, wasn't it? We were never talking really about the weakness in the economy. Those two surprises, those negative surprises from Netflix, I'm just going through those numbers. 20th of January, stock down 22% off the back of earnings. A weak guide down 35% on April 19th. And here we go again, Miller. For Netflix, we're down 70% year to date. Just goes to show how much work we have done in some parts of this equity market already. A tremendous amount for some of those names in the NASDAQ.
And you know, the concern on Netflix is that you've reached some level of saturation already as they switch over to more of an advertising supported model. But remember how well we did during the lockdown because there was nothing else to do. Well, it's been suggested that if we have a deep enough recession and we all lose our jobs, we'll go back to doing nothing else but watching Netflix at home.
I remember when the economy got smashed and my dad cut the cord on Sky Sports. And of course, it wasn't cutting the cord back then. It was the satellite dish on the side of the house. You think about how many subscriptions you've got to choose from, Matt, with the flexibility month on month to make that cut. Tom, you and I have talked about this a million times. It's not just about making the choice to cut Sky Sports or the satellite package. You've got individual choices, $10 here, $15 there. You can start to see some of that emerging, Tom.
Yeah, and Matt Miller talked about fungibility, which means substitution. And, you know, we make jokes about it because we're supposed to make jokes early in the morning. It's not funny, John. I mean, people, particularly a middle class clobbered by inflation, are going to make choices that will go over to entertainment. They're going to go see the new Top Gun like you did. I know, John, you've seen it 5 times. But, you know, the answer is they're going to make choices here. And on the revolution of streaming, it's simple. Paul Sweeney says they're going to get down to three in the house.
I actually went on Sunday, Tom, to watch it for the first time. And can I
What'd
just
you
say,
think?
what an upside surprise, to use some market terminology.
Yeah.
What an awesome movie.
There we go, your movie review
Matt,
for the
I was so impressed.
Well, you know my problem with it.
What was your problem?
Where's Charlie? Right? The whole point of the first Top Gun is, you know, he's going to leave, he's all down and out, but he comes back for this love of his life, Kelly McGillis, and they don't even mention her. All of a sudden, Penny Benjamin is the only one left.
That was some weakness in the story plot. You know what the other one was for me? That they had a generation of fighter jets that they didn't have.
The F-35 wasn't there,
The enemy, Iran, had a superior jet, and I couldn't get my head around that either. And why did they choose the F-18?
I think they used the F-22 because they could put 2 people in it, and the actors weren't allowed to actually pilot the jets. So the actors sat in the back seat or the front seat. I'm not sure which one is. But the F-35, they had some reason that they made up for why they couldn't use it against the Sukhoi 57s, which were awesome.
You know more about this than I do, clearly.
Just to indicate here, folks, the planet that we're not on, I've not seen either movie. And this weekend,
you haven't seen the original?
No. And this weekend, Mrs. Keene said, let's watch Grace Kelly. So we did with William Holden, Bridget Tokary. And she wants the bag that Grace Kelly had in the movie made in 1954. How
much is that?
I don't know. Grace Kelly, I have no idea.
It would
Too
be
much.
cheaper for you to watch
Grace
Top Gun,
Kelly,
Tom.
No, Grace Kelly just killed it with William Holden.
That's what you did over the weekend.
That's what I did
and
over the weekend.
Hot dogs with ketchup and not mustard, apparently.
No, I did not have ketchup. Afterthought I had ketchup.
Another leg lower on this equity market. We're down more than 1% on the S&P. Yields
Kelly
turn lower
killed it.
too. From New York,
You know.
this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In Highland Park, Illinois, a 22-year-old man is being held in connection with the killing of 6 people at a 4th of July parade. Dozens of others were wounded. The man was arrested after a brief chase. Police believe the attacker opened fire from the rooftop of a building near the parade route. China and the U.S. have discussed Trump-era tariffs that President Biden is looking to ease. Vice Premier Li Hu told Treasury Secretary Janet Yellen that the lifting of tariffs and sanctions is an area of concern. There are reports that the president may announce a rollback of some tariffs on hundreds of billions of dollars worth of Chinese goods. That would help lower the costs of everyday merchandise. Global news 24 hours a day on air on a Bloomberg Quick Tape, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We don't think that it's highly likely that they go to 4% in Fed funds rate. We do think that'll be, a little bit too much of a catalyst to the economy. But right now, the market is really corrected with a 3.35 March peak and then almost 60 basis points of easing in the second half. We still think the Fed will most likely do 75 in July.
Leslie Falconio there of UBS from New York City this morning. Good morning. Tom Keene, Matt Miller, Jonathan Ferro. Bramo is back with us next week. A well-earned vacation for her. Then she goes away again the week after that, Tom. Futures down by 1% on the S&P. It's a leg lower here on the Nasdaq 100. We're down by 1.3. A lot of talk about the FX market. Euro dollar with a 102 handle, 102.89.
Yeah, drifting down again.
Negative 1.28%. We have some problems with gas. You know that story. This euro is weaker. This dollar a whole lot stronger. Yield lower again for a fifth straight session, down almost a basis point to 287.29. And here come the downgrades. Jonathan Golub of Credit Suisse was at 4,900 on the S&P for 2022. He goes down to 4,300. He's reiterating his outlook for earnings. That's still constructive, Tom. He says the target is being adjusted lower to reflect the higher cost of capital and valuations. It is not about recessionary concerns. Jonathan Golub of Credit Suisse, Tom, earlier today.
We're going to see a lot of that in the second half of this year. John, I would suggest everyone needs to recalibrate at 8:31 a.m. this Friday.
Well, Tom, you mentioned last week we'd see the downgrades, and here they are.
Well, they are, but John, are they going to recalibrate again off a jobs report that, to our previous guest, suggests a fully employed or fairly fully employed economy?
If you need to recalibrate again, Tom, it will come off the back of the earnings because the data's already weaker.
Or off of your pink slip as you go out the door.
Well, I'm not laughing at that, Tom, because that's not funny.
Right now for radio, this is important. James Bianco is always informed at Bianco Research in Chicago, and he joins us this morning. And he is ensconced with a button on his lapel. And no, it's not some little American flag button. It is a big old whip inflation now button. Jim Bianco, that was from another time and place. The red button, the white letters, Gerald Ford, Greenspan rolled over is the advisor to Ford and said this will never work. And they said no immediate miracles. Turn the button upside down. What is the immediate miracle that Joe Biden needs right now to fix inflation?
Well, I think it is that inflation is the issue. Look, the debate right now in the marketplace is slowing growth and high inflation. And the market seems to want to center on the idea that growth is slowing. So we got to cut our idea on how aggressive the Fed is going to be, lower interest rates because the economy is slowing. I don't think that matters as much. I think that the priority now is whip inflation now, is to bring inflation down. So if the economy wants to weaken, it weakens. As long as prices stay up, I think you're going to see an aggressive Fed, and you're probably going to see higher interest rates and an inverted curve. And to this Friday's payroll report, I've been watching the show this morning. If we do get 250, 300, 325,000 jobs, bad news is, good news is bad news. That just means the Fed could go 75 and can talk about another 75 right after that for the September meeting.
Jim, the hallmark of your work is you look at the glide path, as Peter Orszag would say over at Lazard. And if I suggest a glide path that's nonlinear, there's got to be a kink somewhere on inflation. Let's say we get to 5%. And that's the kink where it becomes different. What's the strategy of the Fed now versus the strategy of the Fed at that kink where they got to get down to the new 2%?
If they were to get to 5%, then I think you'd probably see the Fed readjust. But the June numbers expected, the Bloomberg estimate is another 1%. That means that through June, we'll already have 5% inflation done for the year in the first 6 months. If you look at the numbers from last year, we had 0.4, 0.3s last summer. We could see an 8 handle on inflation well into the fall. And if we do see an 8 handle on inflation, and Chairman Powell has made this abundantly clear, he's not backing off if we don't see the inflation numbers come down.
Well, and he can't afford to now.
You could argue there.
Jim, I mean, he can't afford to now, right? They have to go 75 on July 27th, because if they don't, and inflation pops higher, they risk looking like Arthur Burns.
Exactly, and I think that they've set the stone. They set this in stone, and that's why it's been so difficult for the market to come around to this idea that slowing growth is actually going to matter. And by the way, GDP is out the next day, July 28th, and the Atlanta Fed number at minus 2.1, we're within 30 days of the meeting. It is never beaten by 2.1. So you'd almost have to expect they're going to go 75 basis points, and the next day we're going to get a second consecutive negative GDP print, and we've never had two negative GDP prints that were not in a recession. So this could be very difficult for the Fed that week, that they hike 75 the same week we have a recession.
This is a point that bears repeating, Jim, and I picked up on it by following you on Twitter. The Atlanta Fed Now GDP forecast, I'll just say it again, is for a contraction of 2.1% in the second quarter, after we know the, I think, 1.5, 1.6% contraction in Q1. It's terribly unlikely that they're wrong, right? At least in terms of up or down.
Yeah, I mean, they could be wrong, but are they wrong by more than 2.1%? They've never been that wrong this close to the meeting. Now, there's always a first time for something, but history says that we probably are going to print a second negative GDP number the day after the Fed probably hikes 75 basis points.
And they'll have to hike again, and maybe again. Jim, what a world we live in right now, sir. Jim Bianco there of Bianco Research. We're getting some really interesting calls on the south side. This from Nomura moments ago. Jordan Rochester didn't share this with us, Tom, 30 minutes ago, did he? And he published just now.
Let's explain that. Legally, he can't do that, folks. He's got to sell it to his clients before he sells it to John Ferro.
And here he is publishing. Today's move lower in euro-dollar, thanks to Norway's gas strikes, new highs in German electricity prices, is just a warning sign as to what might materialize. He goes on to say, we have an even higher conviction that euro-dollar will breach parity towards 98 in August, and maybe, Tom, even lower.
So how do you have a higher conviction on a war in Ukraine, Mr. Putin, Mr. Zelensky, and the rest, with all the seriousness of that, with what Folkert's Landau says, at some point they must address strong dollar. A 98 euro is something. That's 0.98, folks.
Within that, Tom, is a call on gas prices. And Matt, I think this is where the FX teams are getting a bit uncomfortable, because they've got to make a commodity call. They've got to make a gas price call in Europe to ultimately make that call on euro-dollar.
Yeah, the connection made by Jordan on this program I thought was fascinating. I just want to point out as well that we talk about the euro at the lowest since 2002. That's when the euro really started. You can talk about 85, you can talk about 2001, but we didn't trade our Deutschmarks for euros until January 1st of 2002, and it was about 90 cents at the time.
Matt Miller, Tom Keene, Jonathan Ferro, futures negative 1% on the S&P from New York City this morning. Good morning. Heard on radio, seen on TV. This is Bloomberg Surveillance. Looking ahead to Payrolls Friday, live from New York City this morning. Good morning with Tom Keene and Matt Miller. I'm Jonathan Ferro. Abramo is going to be back with us next week. She gets a well-earned rest. Futures are down more than 1% on the S&P, just off session lows on the Nasdaq 100, down by 1.2. We've talked a lot about the FX market breaking down on the euro side. Dollar strength just breaking out. Euro dollar 102.96 and down 1.22%. Some really interesting calls out there. Nomura, they get even more bearish on the euro. They're looking for maybe 95, base case 98. That's the downside into August for them. And then into the bond market, 4 straight sessions. Treasuries firmer yield to lower, make it 5. We're down 3 or 4 basis points to 284.18. And it's a core government bond rally, Tom. Go to Germany. We're down 12 basis points on the front end in Germany today, Tom. Down 12 basis points on a 2-year, down about 10 on a 10-year.
And I would emphasize, John, a lot of this has happened in the last hour off of different headlines, some from Germany, some not. The equity market, it's down, but it's not down to where it was June 30 or July 1. The Dow, 331 points. The VIX really hasn't come out yet, John. A VIX over 30 would get my attention.
Just to recap the adjustment over at Credit Suisse, Jonathan Goldberg's been pretty constructive for the back half of this year. He mentioned to me only last week that we could see a double-digit gain. That's not the call anymore. 4,300 is the base case. 4,900 was the case previously. That's a big cut. Making the point that this is not recessionary concerns for the team at Credit Suisse. But, Tom, the cost of capital is going in the other direction. big time.
Well, the cost of capital will be at both nominal and real, and that is a good place to start with John Riding, his chief economic advisor at Breen Capital, has been of assistance to us for many, many a year. And John, I think the question right now on cost of capital is now, do businesses, do they think in the nominal space, or is everybody a slave to the inflation-adjusted analysis?
Well, Tom, if you think about it, we haven't had these kind of inflation problems since the late 70s, early 1980s. So many businesses are simply not used to handling an inflationary environment. And money illusion exists amongst consumers, and money illusion exists amongst businesses as well. I mean, if you look at the policy rate, so start with the policy rate, with a CPI inflation rate of 8.6%, you're still looking at a policy rate that is extremely negative in real terms. So all the anxiety about the Fed raising interest rates, it has to be looked at in the context of that inflation rate. And businesses, I think, the idea that we've had this bear market in equities, but it's been a multiple adjustment to a higher nominal yield. It hasn't so far been an earnings adjustment.
And I think of you and Michael Darda on this, and this is with your work at the Bank of England at the Fed years ago. So many people haven't lived this. And what I'm hearing from relative optimists, we will adjust as yields move higher. We will adjust as Powell, Lagarde, and the rest bring up interest rates like New Zealand this morning. Do you have that optimism that we'll adjust along the way?
Well, there will be adjustments along the way. And to the issue, and sorry to take issue with Matt, for example, 2 negative quarters of GDP, if we have them, don't make a recession. A recession is inevitable, but I don't think that it's imminent. And as companies, I don't think companies experienced a recession or negative GDP in the first quarter. If you look at the income side of the accounts, a second equally valid measure of GDP expanded by 1.8%. And if you look at business surveys and you look at household surveys, people are negative about the economy because they're trying to handle this inflation problem, but they're relatively positive about their own financial prospects. Companies are relatively positive, small businesses are relatively positive about their own outlook. So there's this disconnect because people are trying to adjust to that inflation problem, and they haven't experienced doing it. But research shows, contrary to what the Fed has tried to do, that households do not like inflation. Businesses do not like inflation.
Yeah.
I'm worried. And ever since Lloyd Blankfein told me to get my house in order, I've been freaking out about this. But I want to ask a couple of more Eurocentric questions, John. I asked Tom a couple weeks ago if a weaker currency is better or worse in terms of inflation. How is Germany experiencing this in real time right now? As we see a euro go down to 102, the inflation picture had rolled over there. Is it on the way down, or can it pop back up?
Well, we have to remember that when it comes to using currencies to judge inflation, currencies are a relative judgment. It's a relative judgment about the Federal Reserve versus the ECB. And it is quite clear that the Federal Reserve is much more aggressive and planning to be more aggressive in hiking rates than the ECB. So the currency reflects that relative judgment. But the U.S. has had a strengthening dollar and is suffering just as bad an inflation problem as is being experienced in core Europe. Certain parts of Europe, Latvia, for example, was referred to in Powell's hearings. Inflation north of 16%, inflation in Spain, 10%. Those are way above the 2% rate that the ECB is which has one objective. The ECB doesn't have a dual mandate. It has a single mandate.
And John, as futures deteriorate, -43 on SPX, and we're watching Euro really not through the new weakness, 102.88. John, what's so important here is Elarian and Riding seem to be on the same page, that on a relative analysis, there's some real urgency here.
Well, I'm looking at the urgency of some of the data we've seen recently, John, and allow me to go through it. The ISM down to 53 from 56.1. We'll take that. For the new orders component dropping into contraction territory for the first time since May 2020. It's part of the reason we see what we're seeing on the screen right now, and allow me to go through that with you. Yields are lower for a fifth session. We're down 4 basis points on a 10-year to 284. On twos, we're down a basis point to 282. The difference between twos and tens, a couple of basis points. Twos and fives, nothing. They're basically in line with each other. So, John, we're starting to see that inversion again, off the back of weak economic data and a Fed that's determined to carry on hiking. Can you walk me through where ultimately you think this is going in the economic data? You've pushed back against that argument for a technical recession. Just where are you seeing pockets of weakness that you think we should focus on?
Well, I think a working hypothesis I have when it comes to looking at some of those manufacturing numbers, like the ISM that you referred to, is in the midst of all of the supply chain difficulties, and those supply chains are only easing slightly. Companies may have over-ordered in order to try and get some inventory to meet the demands of their customers. And so with that comes a sort of cycle adjustment where you've over-ordered. You cut back on your orders because you start to see better improvement in your supply chains. And it's not really final demand that is the problem here. For example, in the first quarter, even if we take the GDP contraction at face value, that was coming off of an inventory adjustment from the fourth quarter. Final demand was relatively strong. It was 2% in real terms, but in nominal terms, it was much, much faster. And so my greater concern is the impact of inflation eating into real purchasing power than it is this adjustment in the manufacturing sector that we're seeing, that I think is quite possibly an adjustment to over-ordering to get through supply chain difficulties.
So, John, if that is your base case, can you walk me through how that shapes your Fed call about how far they can take Fed funds?
Well, I think it's clear that the Fed has signaled they want to get a positive real or inflation-adjusted Fed funds rate. Now, for next year, the Fed has, at the end of 2023, a 3.8% Fed funds rate assessment as the median assessment of the appropriate funds rate against the backdrop of a 2.6% inflation forecast. Now, I think it's extremely unlikely that inflation, which this year is likely to run at around 5.25%, is going to slow so much. We have a real inflation psychology building in. So let's say inflation runs at 3.5% next year, which I think is more likely. Then you're looking at a Fed funds rate that may get to 4.5%. And is that a mistake? It may be a mistake in backward looking, but you may remember some while ago, and Lisa's not here, but
Thank God
Lisa
for that.
said, what if the Fed overhikes it? What if they make a mistake? And I said the mistake was already made. It was made last year when the Fed continued to ease into a rising inflation problem.
Right.
Now they have to correct that problem, and they're only they don't have a model of inflation that works. They're backward looking. They want to see a compelling reduction in inflation, and it probably means they'll over-tighten the funds rate. And that is when you get the recession problem, probably late 23, 2024.
Futures negative 43, Dow futures negative 340. John Riding, let's cut to the chase. John Ferro and I are going to be in Washington this week. We will speak with Adam Posen, who suggests 3% is the new 2%. Blanchard and others coming out of the great financial crisis even modeled out a 4% need on inflation to get things going. Where's the new 2% for John Riding?
The new 2% should be sub 2%. It
Sub
should be
2%.
It's clear that the work on what consumers believe about inflation. They believe inflation is bad. So the Fed may have a model, and Posen and others may talk about a faster inflation rate to get the economy going. The faster inflation rate is what is killing this economy to the extent we are being hurt right now. That is a real problem. And households don't like inflation because it erodes their finances, and they see down the road there being some action to be taken to rein inflation pressures in. So we had for more than 2 decades a relatively stable 2% inflation rate. Can we keep a stable 3% inflation rate? Can we keep a stable 4% inflation rate? No, history suggests not. History suggests not.
They don't talk about flexible average inflation targeting anymore, do they, John? What do you make of that?
Well, John, in September 2020, when the Fed introduced, we're going to average 2% inflation, that's going to be our target, which means we're going to overshoot inflation, they really contributed to getting inflation out of the bag. And it wasn't just the average inflation targeting. It was the backward-looking nature. Right. We have to hit 2% inflation. We have to hit maximum employment. We have to have the prospect to be moderately above 2% for some time before they even began lifting off on rates. So no, I mean, if you talk about averaging 2%, it becomes a real a real problem given how high inflation has been. And so the Fed they put in escape clauses. They're going to switch back at some point just to straightforward 2% inflation targeting, but we're a long way away from that number right now.
John, we got lucky. TK, very lucky. What a clinic from John Riding of Bring Capital.
It is. Futures at -42. Markets here really something, John. I mean, to get to Friday is not a small matter.
Tom Keene, Matt Miller, Jonathan Ferro. Bramo with us next week. I'm going to run away.
She just sent me an email. She says they don't call it feta cheese and cream.
What do they call it?
It starts with an M.
What do they call it?
I don't know. It's
These
a
are
Greek
important
word.
issues, Tom.
I can't
Get to the bottom
pronounce
of
it.
Try.
Velveeta. I don't know.
Peter Cheer of Academy Securities joins us in the next hour on Bloomberg TV. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A 22-year-old man is being held in the deadly shooting at a 4th of July parade in Highland Park, Illinois. He was arrested following a brief police chase. Authorities say a gunman opened fire from the rooftop of a building near the parade route. 6 people were killed, dozens more were wounded. President Biden marked the 4th of July holiday by noting the U.S. has made great strides, but has also taken a few steps backwards. At a White House event, the president said Americans are worried about divisions within the country. He also described the economy as growing, but not without pain. An indicator of U.S. supply chain pressures, the Logistics Managers Index fell to the lowest level in 2 years. There was a sharp drop in transportation costs, which underscores the slowdown in the economy heading into the second half of the year. Warehouse prices, capacity, and utilization also fell. Scandinavian airline SAS has filed for bankruptcy protection to deal with its debt burden for the second time in just 2 years. The carrier has been in talks with its creditors to convert $1.9 billion of outstanding debt and hybrid notes into shares. SAS also plans to raise additional equity for about $1 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think the risks of a 2022 recession are significantly higher than I would have judged 6 or 9 weeks ago.
Lawrence Summers, a former president of Harvard, and of course, Secretary of Treasury there with David Weston, Wall Street Week, on the gaming of recession. Certainly the zeitgeist, Matt Miller, this weekend was that Lawrence Summers absolutely nailed the non-transitoriness of where we are, and the now what is open to great debate, Matt.
Yeah, absolutely. In fact, there's been a debate on transitory again, I think, because we've seen inflation rolling over in some places. If you look at the chart of fuel and food and especially metals, it's really come down, but that may be a head fake, as we know, and I think most people, the consensus now is that numbers can still go higher.
Well, we'll have to see. Right now, on China, on tariffs, Kriti Gupta. Kriti?
Well, as we talk about that inflation that may or may not be coming down, as Matt pointed out, Tom, you have to talk about what can the Biden administration actually do. More and more calls for the Biden administration to ease perhaps some of the tariffs, which brings me to my chart of the day. The amount of tariffs, or the percentage of tariffs on a global trade-weighted basis on Chinese goods in particular, from the United States to China, we're looking at a percentage of 19.3%. For our radio audience, basically, it's a story of the trade war that we've seen over the last 2-3 years going into 2018. But think about this, 19.3%. If I were to graph this on Chinese tariffs on U.S. products, it'd be about the same, about 20%. So it's that tit for tat that a lot of people are saying, is this the solution to perhaps easing some of those import prices, Tom?
That's all you got this morning?
I got to keep it short and sweet.
Got to keep it short and sweet. That was very, very short and very sweet. And also, folks, very, very nuanced here. The tariff story reported this weekend deserves a little more analysis than maybe what we're seeing. This is a joy. He has been pushed aside by news flow recently, and he's been just incredibly on at Ritholtz.com. Barry Ritholtz does Masters in Business for us, hugely successful, and also runs real money at Ritholtz Wealth Management. Barry, I absolutely love your essay on hand-wringing. Get over it. Tell me what the quality of our hand-wringing needs to be.
Well,
it has to be data-based. You have to understand what makes the current circumstances so unique compared to previous scenarios. First, let's get this out of the way. 2 consecutive quarters of negative GDP is not the definition of a recession and hasn't been since the NBER has been put into place in the post-Great Depression era. If you don't have a broad economic environment, if you're an emerging economy, well, then you could use that as a shorthand. But there have been all sorts of different changes that have been going on in the present economy that it just seems foolish to apply old discarded rules to a new scenario and say suddenly this is a recession when most of the data does not support that.
Barry, I will tell you, that's exactly what Gary Schilling told me when I asked him about this on Saturday. But the NBER doesn't tell us oftentimes that we're in a recession until after we're out of the recession, right? I mean,
right.
That's pretty useless.
Well, what are you using their declaration for? You're certainly not using it as a basis for making investment decisions. So, when we look at past recessions, we see a decrease in economic activity, primarily in employment and wages. That's the biggest driver. And go back to January through June. Yeah. Unemployment went from over 4% down to 3.6%. We have never been in a recession with declining unemployment. Now, I don't want to say it'll never happen in the future, but it makes it much more challenging. When we look at the economic data, what we're really seeing in negative GDP is not so much a decrease in economic activity as we're seeing a massive surge in inflation. Remember, GDP data is real, not nominal. And so if it tips into negative territory, it's partially due to inventory buildup, but it's also due to inflation.
Very quickly here, I want you to tell me what to do if I'm in cash. People are in cash. They're fat and happy right now in a tough market. Futures negative 45, Dow futures negative 351. What's the Ritholtzian process to get back into the market if I'm in cash?
So first, the data shows 2 out of 3 times you're better making a lump sum payment than you are doing dollar cost averaging over time. But people have a hard time emotionally making that one-time investment. So you have 2 ways to approach this. You could do this over time. Hey, I'm going to break this into 5, 20% lumps, and every other month put that much money to work. So you're buying on the way down and you're buying on the way up. Or you could do it on a percentage basis. We're down 20%. I'm putting some money into the market. Down 24%, down 28%. But pre-decide and execute it and make it automatic. Don't rely on yourself to do that, because emotionally, most people become paralyzed. And in the sea of red, it's very, very difficult to say, let me throw good money after bad. People seem to have a hard time with that.
It's a great point, Barry. And again, I was watching you on Surveillance last week, and you said something like, it's your mindset that's the most important variable when it comes to success in investing. And I think that's another example. Barry Ritholtz, great to have you on. I always watch or read your blog at The Big Picture, Ritholtz.com. And of course, he's a Bloomberg contributor as well. So, Tom, I guess the point is it's always better to just jump straight in the pool rather than put your toe in and then slowly get deeper and deeper. But it's terrifying.
Yeah, it's terrifying. That's the key point. It is just everything against the human condition. Barry's math is absolutely correct. There's some great work on this we mentioned last week. Capital Guardian Trust out in Los Angeles and in others. It's wildly asymmetric. It is so hard to get back into the market, Matt. You see futures negative 46, Dow futures negative 363. Do you want to go long this morning, Matt?
Well, I don't have the courage. What do you call it? You have a phrase for this. I never have the courage to be invested. So I just hand that off to someone else. But there are braver people than I, and they may be in the mood to go long, especially when we see futures down more than 1% after the drops that we've seen thus far in the first half. The question is, will the second half be even worse?
Matt Miller and Tom Keene, thrilled you're with us this morning here as we wrap up an eventful hour. Matt, I've got to take it here in the last minute to what I've avoided with John Ferro. We were very successful at avoiding Bitcoin, 19,400. Matt, Bitcoin got through a long American weekend. How did it get through without caving again?
Well, Bitcoin traditionally does much better when the market's not open. If you, for example, always buy at the market close and sell at the open, or if you only buy at the weekend and then sell before Monday starts, you do better.
All right, well, we'll have to see here. Let me look at the foreign exchange market. DXY is a huge story today. 100, 102, 104, 106, stronger U.S. dollar, and euro, stunning, a 102.90 under 103. That means you need to stay with us on radio and television through this eventful Tuesday. This is Bloomberg.